And we are going to share my screen. And we're going to kind of just jump right in. We started, we're in Unit 15, and we started talking about kind of the procedures and the practices for the loan. I think in practice for us, this is probably one of the more important pieces. Just because we're the ones working with buyers, and they're going to ask us questions about their loan process. What's taking so long? What's the lender doing? Why are they getting all this information? So it's just so important that we have this basic understanding so we can just kind of help the lender through the process. Obviously, once again, we are not in lender school, but we do, feel free to always send your buyer to the lender if they have questions. But just having this basic understanding. So where we left, can everybody hear me okay? Can I get some thumbs ups? Okay, good, thank you. So we left talking about the loan application. We're going to talk a little bit more about the loan application when we get to Unit 21. But just again, having a basic understanding, the lender has to collect information from the borrower. They have to get information about the property. So the loan application, the idea of the loan application is actually 6 different pieces. It's a piece, about 3 pieces about the people and 3 pieces about the property. Once we go under contract, then we have a property, but the lender can't run the loan application until we have a contract. So we know which property, particularly what price we're looking at, so the lender can figure out their loan to value ratio. Any questions about anything we've talked about so far before we get more into this practices and procedures? Okay. Yeah. Is it a question or a mute? Let's see. Good morning. So one of the big things that we can do when we're working with buyers, one of the big things that we can do to help the lender is to help have a conversation with the buyer about what they should or should not do once we start that loan process. This is, I hope we kind of see the humor in this, but guys, this is real. There have been buyers under contract that have gone out and financed a brand new car. That ruins their chances of getting a mortgage loan. There have been buyers under contract that have run to Rooms To Go and opened an account and got, dining room, living room, started furnishing this home that they don't own yet. And then they don't get loan approval. So I know they're excited. I get it. Your buyers are excited and they want to start furnishing their home and they want to buy a brand new car for the garage. I get it all. But this is probably one of the big things that we can do to help the lender, is to make sure that our buyer understands that they are here. I once had a lender explain to me that when they start the loan application, they kind of do like a snapshot of the lender's credit. What's all your income? What's all your debt? What's this snapshot of your credit where you are right now? Then fast forward to closing, and right before they give you final loan approval, they do another snapshot of your credit. In order for your buyer to get loan approval, both snapshots have to match. So whatever their credit looks like when we go under contract and they start the loan application is awfully close to what their credit needs to look like when they're going to close before we get that final loan approval. So have this conversation, make sure they can understand the importance of not running out and buying a new car. They can do all that after closing. Again, they're excited. I get it. They can do all that after closing. So one thing that the lender looks at are your credit scores. This is only a very small piece of what the lender looks at. So the credit scores in general range from 300 to 850. 850, the higher the score, the lower risk you are. Because if you have a credit score in the 800s or the high 700s, that shows the lender that you pay your bills on time every time, basically is what we're saying. You manage your debt and that looks good to them. Again, it's so important that we understand that all lenders are created differently. So some put more weight on this credit score than others. I do know, I think for the most part, lenders are saying, look, if your credit score is under 550, 600 in some cases, we can't do anything. Again, they're all different. But what a good lender is going to do, if your credit score is 500, what a good lender is going to do is work with that buyer to help them get that score up. So maybe they're not ready to buy today. Maybe we've got to get some of their debt paid off. But a good lender will work with them, because when they are ready to buy, doesn't that lender want that buyer to still use them? And they're going to remember them as like, hey, they're the ones that helped me get here. So they're going to be the ones that I'm going to use. Good morning. Same thing with us, you guys. We may have to incubate some buyers. If your buyer's not ready to buy today, but they're working on getting their credit score up, stay in touch with them. It may be 2 years, 5 years. You're not going to run around showing property until they're approved, but you need to stay in front of them. So, stay card, call them every once in a while, ask them how they're doing, but just stay in front of them. So when they are ready to buy, they will know to call you. So credit scores. The other thing that the credit or the lender looks at is your credit history. The underwriter is the one that kind of crunches the numbers. We'll talk a little bit more about the underwriter in just a second. But they're the ones that crush all the numbers. They're the ones that dig in depth, dig in detail. They're the ones that go through all your personal finances. They learn everything money-wise they can about you. And what they're going to start looking for is 2 years of detailed your history, and they want to see 7 years of a repayment history. So your buyers are going to have to gather some documents. Again, I think this is a good conversation that we can have with our buyers. Make sure they understand the importance of getting the lender what they need. Lenders work in a process. So like before they do B, they have to complete A. So they can't go on if they're waiting for your buyer to send them paperwork. Does that make sense? Would it surprise you guys if I told you there are cases where the buyers delay their own closing because they don't have the paperwork, because they're not getting back to the lender? So again, be in the front line, the one that your buyer communicates with. We can help the lender in getting them what they need. When my buyers go under contract, we of course do our little mini celebration, yay. And then I tell them, once we're under contract, I tell my buyers, you need to make the lender your priority. You call the lender back before you call me back, because we want the loan application to get through the first round of underwriting while we're still in due diligence. And it's not uncommon for that loan to come out of the first round of underwriting with maybe the lender's requesting more information, maybe they need some more paperwork. But usually what we can get from the first round of underwriting is what the lenders will tell you is a pretty good idea. So is there a pretty good idea that we're going to get loan approval or not? Based on that information, your buyer has a decision to make. Do we want to move forward, go past due diligence? Or does it not looking like I'm going to get loan approval, in which case I need to terminate so I can get my earnest money back? So they're going to pull some history. Again, if they need more, they may request more than 2 years of history, 7 years of repayment history. Again, if you don't have a great credit score, if you don't have a great credit history, then you're going to be ineligible for some loans, particularly with the credit history, FHA and VA. Once we get through the process a little bit further, at some point, the lender is going to rate lock. And once your interest rate is your interest rate for the entire life of the loan. Remember, your debt service, your principal and interest stays the same. And that does include your interest rate. So at some point, as part of the process, and the lender will be in communication with your buyer about this, they're going to lock in the interest rate. So if we lock it in today at 4.5%, how old is this slide? This was like a couple years ago, or a couple months ago, I guess. But if we lock your interest rate in at 4.5%, and tomorrow it drops down to 4, you're locked in at 4.5. If we lock you in at 4.5 today, and tomorrow it jumps up to 5, at least you're locked in at 4.5. So I think as buyers kind of be familiar with interest rates, and especially right now, how rapidly they're adjusting, they may want to get locked in now before they go up anymore. So when it comes to the loan, what's this mean for us? What's the broker's piece? As we've been saying, we need to have a basic understanding of how lenders are going to decide whether or not to approve a loan. Having that basic understanding can help us help the buyer through the transaction. I know I've mentioned this before. The loan process is hands down the longest part of the contract to closing process, hands down. So if a lender's involved, that's what's going to take us the longest. As an agent, especially the buyer's agent, we're going to be the one writing up the offer. So we're going to be the one putting in, for example, how much time do we want for due diligence? How much time do we want before we go to closing? All lenders are different, you guys. So if you've never worked with this lender before and you're writing up the offer for your buyer, you're going to want to call the lender and ask them, how much time do you need for due diligence? Let's work together on this and try to get that for our buyer. We mentioned briefly the other day the difference in pre-approval and pre-qualification. I do think, again, it's important we have a basic understanding of that. Pre-approval means that the borrower has contacted the lender and given them their numbers. They've said, this is how much I make, and this is how much debt I have. And based on that information, the lender will issue a pre-approval. A pre-qualification then is taking it a step further. Now the lender is not relying on the numbers provided by the buyer. Now the lender is verifying those numbers themselves. So I think through the eye, no, I don't think, I know through the eyes of the seller that a pre-qualification is much stronger because the lenders actually crunch those numbers. They've looked at those numbers. What we all need to understand is that neither a pre-approval nor a pre-qualification are guaranteed. We still don't have final loan approval until the lender is processed. I have two favorite emails in this industry that I receive. My second favorite email is from the lender, and that email says, we are clear to close. Once you get that clear to close from the lender, then you know that you've gotten your loan approval and we can move on with settlement. We can get ready for settlement. As we mentioned earlier, it's not uncommon for the loan to come out of the first round of underwriting, requesting more information. It's really uncommon for us to have this approval while we're still in due diligence. A lot of times we get this final approval, the clear to close, days before settlement. So again, once it comes out of that first round of underwriting, what we can get from the lender is a pretty good idea or not if we're going to get approval. So the buyer really needs to listen to that, understanding there is no guarantee. In all my years, I've only known one buyer to get a clear to close while we were still in due diligence. So the norm is to find out. And again, if the lender doesn't have a pretty good idea, it's up to your buyer, of course, but we may want to remind them, if we terminate you now, at least I can get your earnest money back. If we terminate within due diligence, at least we can get your earnest money back. have any questions so far? Okay. So again, with underwriting, man, they don't leave any stone unturned these days. If there's something in your credit, they're going to find it. So they do a credit characteristic. They look at your credit history. Again, if they need more information, they will reach out. They will request it. They're going to look at your assets, your stability of income, acceptable forms of income. We mentioned the other day the housing market crash, and there's a cajillion theories out there about what went wrong. And another theory, other than fraudulent lending practices, another theory was illegal sources of income. So, okay, now we're talking drug money and mafia money. So the lender's got a source where your cash comes from. If you're going to bring a down payment, for example, if you're thinking about buying a house and you have a mattress full of stuffed of cash, you may want to go ahead and get that in a bank now. So when you're ready to buy, they can source that income. They can source where that cash came from. You can prove that it wasn't a fraudulent or an illegal source. They leave no stone unturned these days. I've had several buyers contact me through the process and say, wow, the lender and I have a relationship because they know so much about me. I sometimes think of underwriting as like this black hole somewhere. If you ever, when you call your lender and you say, hey, how's the loan process going? Where are we? They're always going to say, well, it's in underwriting. I'm like, where is that? Is that someplace that exists? Where can I find that? But now I know, again, it's just the number crunchers, the people that are verifying and digging into your credit history, your credit story. So we're going to talk in just a minute about qualifying our buyer, but there's a couple ratios that we need to make sure that we understand what they're about. As you can see with your conventional loan, there's two ratios of 28-36. We will talk in just a minute about what these ratios mean. Your FHA ratios are typically 31-43, and then VA only has one because they use a different type of qualification. So they don't look at both ratios as conventional and FHA do. This is the math that we're getting ready to do or introduce you guys to in just a minute. So we'll see these and talk more about what these numbers mean. Questions? Anything so far? Okay. So the other day we introduced you guys to TILA. TILA is the T in TRID. So remember, TRID consists of TILA and RESPA, integrated disclosure. We're going to get a little bit more into TRID and RESPA when we get to Unit 21. But right now, let's talk about TRID, or TILA, excuse me, TILA, the Truth in Lending Act. TILA can also be referred to as Regulation Z. I would know that TILA can also be referred to as Regulation Z. I would definitely know that information. When you guys see TILA, when you guys see Truth in Lending, I want you to see lending. TILA tells the consumer, how much is it going to cost me to get this loan? What are the costs revolved around obtaining and originating this loan? TILA is regulated. Again, we met the Consumer Financial Protection Bureau the other day. They're out to protect the consumer. This is a fairly new program since the housing market crashed. And one thing the CFPB did when it comes to mortgage loans is it said, you know what, we need to educate the consumer. The consumer needs to be knowledgeable about this 30-year mortgage in some cases that they are getting ready to get. They need to know the terms. They need to know what they're getting ready to commit to. So TILA now requires the consumer to be fully informed. And particularly, they address these chief disclosures, which we'll talk about. The things that TILA and the Consumer Financial Protection Bureau considers these chief disclosures, your APR. APR is your annual percentage rate. APR is a more accurate number of the financing than just the interest rate. So APR includes more than the interest. It does include the interest rate, but it includes more, and it gives the consumer a better idea of all of the charges, of everything involved with the cost of this loan. TILA also requires that the consumer be informed of their financing charges, any financing charges that are associated with the loan, what's your total number of payments, and how much are you going to make. Remember, your debt service is your principal and interest, and your principal and interest stays the same for the life of the loan. So you know when you're applying for this loan, how much that debt service is going to be every month. All that adjusts is your taxes and insurance. And then another chief disclosure, things that we need to inform the consumer about, is how much are you going to finance? What's the loan that you're asking for? Is it a $100,000 loan? Is it, 80% of the purchase price? And one big thing that TILA does to protect the consumer is it regulates advertising. Advertisements about mortgage loans, specifically just about mortgage loans. And when it comes to advertising, TILA has identified things known as trigger terms. We're going to look at some examples in just a second. But a trigger term is when a specific number about the loan is mentioned in an ad. Again, we'll look at some examples in just a second, talk a little bit more about that. And what TILA says, if you hit a trigger term, if in your ad you mention a specific number about the loan, then TILA requires all of the information about the loan to be disclosed. Here's the deal, you guys. When it comes to getting a loan, we are not all created equal. And TILA says if the lender's going to be bold enough to advertise a specific number, basically what they're offering is a one-size-fits-all loan product. Every single one of us on this call has a different credit history. We all have a different credit score. We all have different loan information. So we all would walk away with a different type of loan. If we really wanted to have some fun this afternoon, we could all call the same lender and apply for the same amount of money, and we would all walk away with different terms because we all have different credit histories. That makes sense? So what TILA says is, look, if you're going to give us a specific number, then what you're saying is this loan is a one size fits all. What applies to one applies to all. And that's just not the way this works. So let's talk about these specific numbers. What are these trigger terms? Anytime you hit a specific number about the amount of the down payment, any payment amount, the number of payments, the period to repay, or the dollar amount of the finance charge. For example, it's the difference in saying 0 down in your ad versus low down payment. Once they advertise 0 down, or you can get this loan for, an interest rate of X amount, or if you can get, 30-year loan. Once they hit this trigger term, once they hit these specific numbers, that's when they have to, their trigger terms have been triggered. That's when they have to give all the specifics about the loan. This is what I think is important that we understand. Trigger terms are numbers about the loan. When you guys see test questions, you see a number and you get excited and you say number, that's a trigger term. Make sure it's a number about the loan. So you guys do your heads one way or another. Is the purchase price, is the listing price, is that a number about the loan? Does that have anything to do with the loan? No, the seller's just saying, this is how much I would like you to buy my house for. That's not about the loan. So we can advertise the listing price, not hit a trigger term. What if the ad says something like $500 a year HOA dues? Are HOA dues about the loan? Do we hit a trigger term? No, I hate to say they like to trick you guys, but come on. They're going to put numbers in there. Just because you see a number doesn't mean you're looking at a trigger term. You need to make sure that that specific number is about the loan. Do I have any questions so far? So you hit these trigger terms. Again, just a couple examples. Do you guys see the difference? $600 monthly payment versus low monthly payment. What is that trigger term? It's the one where we mentioned $600. You guys see that difference? Zero down versus low down payment. That's what we mean about a specific number. The lender can avoid hitting these trigger terms as long as they speak in general. What may qualify for a loan down payment for you may not qualify for a loan down payment for me. But if the lender is bold enough to say, you can get this loan for zero down, then what they're saying is any consumer anywhere can get this loan for $0 down. That's what we mean. So also, as we mentioned, it's a number about the loan, the list price, HOA dues. And I think that's what we tend to do during the test. We see a number and think, oh no, it's a number, we've hit a trigger. No, please make sure it's something about the loan, one of those specific numbers. When one of those numbers are hit, these are the things that the lender must disclose. Once we hit a trigger term, the lender in their ad also has to say the total amount of the loan, the actual amount of the down payment, frequency, number, and amount of payments, actual interest rate, and total required payments. Again, the lender's saying if you're bold enough to advertise this, then you need to give all the terms. Mortgage loans only. I don't know how other loans work. Do you guys ever, I have to wonder they don't work the same. Are you guys ever watching TV and there might be a loan on maybe a car loan or something, and they hit a number and then all of a sudden the announcer gets real quiet and they talk real fast and can't really understand what you're saying. I feel like they've hit something and now they're disclosing the rest of it. I don't know that non-mortgage loans work the same way. And the wording on the TV screen gets like that big and you can't see it for nothing. I feel like they're disclosing something. Evidently, they don't have regulations on how they disclose. We don't have to be able to hear it or read it or understand it, but they're disclosing. Again, we're just talking till it's specifically about mortgage loans. So once a trigger term, specific number, then the lender in their ad needs to disclose. There you got fast talking auctioneer. Yeah. I'd love to learn how to talk like that. So gee, Julie, what's the big deal? Well, let's see, bottom of page 409. What are the penalties for violating TILA? What are the penalties for advertising these trigger terms and not giving specific numbers? You could be looking at a fine of $10,000 per day per violation. Other fines as well. You could possibly go to prison, serve some prison time. How do you think the North Carolina Real Estate Commission is going to respond to this? Not well, right? Now we got disciplinary action as well. So you could be in danger of losing your license. So, okay, we've decided that TRID and TIL are lender laws. So why do you and I care about this? If this is a lender law, why do we care? Well, let's say you get a really nice listing. Let's say you get a really nice listing and you decide you want to do an agent luncheon. So you're going to throw lunch one day and you're going to invite all the agents in the area to come ooh and ah over your new listing and hopefully introduce it to them so they can bring their buyers. And while you're getting ready for this agent luncheon, you call your lender buddy and say, do you want to go in on this with me? And of course, your lender buddy is going to say yes, because what a great opportunity for them to meet agents. So it's kind of a win-win, right? You hopefully get a buyer and your lender buddy meets other agents that they can do business with. So your lender buddy says, of course, I'll go in on this agent luncheon with you. And they say, I'll tell you what, Julie, I'll go ahead and do the flyer to promote it. Should you want to see that flyer before it goes out? Because when they do that flyer, they're putting their name and number on it, but guess what? They're also putting yours. So now if their flyer hits a trigger term, are you advertising specific numbers about the loan, your name and number and picture, smiling face is all on there. I think that's a good, and we work closely with lenders regularly in various projects. And I think making sure that you put your set of eyes on that ad, on that flyer before it goes out, just to make sure there's no violation. I think another example, I predicted this one and I've already seen it. We talked, I guess it was the other day, about we're going to see buyers assuming more loans, assuming the seller's loans, because they're going to take advantage of that low interest rate. Guys, I was in MLS the other day and I saw an agent advertising. Buyer can assume the seller's loan at 3.5% interest rate with specific number down payment. I mean, they hit them all. They hit them all. And they didn't have the rest of the information. So even though we necessarily aren't advertising loans, when we run into situations like that, where your buyer might be able to assume the seller's loan, we just need to be very, very, very careful what we put out there, our advertising, especially with the loans.
I have a question.
Please.
So in that situation, they are with a broker, right? So
Yeah.
who, like, would the broker not, I don't know, isn't the firm supposed to help navigate through this?
Supposed to, yeah.
Because I mean, not that we're not learning something, but when we sign up with broker, that's the whole point, is them helping make sure we don't do stupid stuff like that.
Completely. And let me just say, some are more helpful than others. Some offer more training than others. Some are more involved. Some are more hands-on than others. So to your point, wouldn't that be a great flag? I mean, if I were that agent, I'd be like, whoa, why didn't somebody, we'll talk about the broker in charge's responsibilities when we get into license law and commission rule. And advertising under the firm's name is something that is the big's responsibility. So should they have caught it? Oh, you betcha. Did they? Nope, because I saw it. At least I'll say to their point, it wasn't a public ad. It was when we go into MLS, we have a place to do agent only remarks. So you have to be a member of MLS to see agent only. And at least I will say that that was in the agent only. It wasn't out there for the world to see. So at least there was that. Other questions or comments? I guess the point that I need you guys to hear is, before you put anything out, marketing, advertising, it can't hurt to have somebody else look at it, offer an opinion. A question comes in, a firm, do you have somebody who specifically writes the ads, or is it a group effort? Usually each listing agent writes their own ad, but you can always ask for help. I'm not the best one for writing stuff. So I like the agents that use the ad to paint a picture of the home. You could almost see the home by reading their advertisings. I'm not that agent, so I ask for help
Okay,
when I
because
come to writing.
I know of a firm in the Cary, Raleigh area that they have someone that they contract out that writes it for them. And I just
There you
wouldn't
go.
feel that writes all of it for them. And I guess that would just make me a little uneasy too.
Yeah, well, I mean, that's interesting. I hadn't heard of that service yet, but I mean, sure. But you guys, before you hit submit, if you got somebody else writing your ads, before you hit submit, make sure you put your eyes on it as well. Make sure you proof it.
Yeah, I
This is
think
the
this is
internet we're talking about. Yeah.
Yeah, I think this is someone that like is just an individual broker by themselves. They really don't have, so they kind of hire out different pieces to help them. But I don't know if I would trust that.
Yeah.
I'd be afraid.
You can find help for anything, can't you? It's out there. So definitely just proof it. Yep. Because once it goes out there, it's out there, right? That's the thing about the internet. There ain't no getting it back. So once you get it out there, just make sure that it's good. Other questions or comments? Good morning. Let's see. Federal Equal Credit Opportunity Act. This is the lender's fair housing. When you guys see this, again, Equal Credit Opportunity Act, if it's about credit, if it's about the loan, then it's about the lender. So the lender has protected classes. We can see here that they cannot discriminate for a loan application based on the basis of race, color, religion, national origin, sex, marital status, age, or dependency on public assistance. Section 8 housing, for example. When it comes to age, this is assuming that the applicant is at least 18 years old. So you can't have, under 18 applying for a loan. What this means though, you guys, if a 90-year-old walks into the bank and applies for a 30-year mortgage, they cannot be denied the loan because of their age. So once you turn 18, age is not a factor. The Federal Equal Credit Opportunity Act also requires the lenders to report to candidates if their loan was denied. So they have 30 days to send a report telling them that their loan was denied and listing the reasons why. And bottom line, it better come down to their debt to income ratio doesn't work out. The numbers don't crunch. It better not be because of the basis of their race, color, religion, national origin, sex, marital status, age, or any dependency on public assistance. We're going to see this again when we get into our fair housing. Our fair housing unit is Unit 19. So we'll see this again, and we'll actually compare the lender's protected classes to our protected classes. There are some similarities. There are also some differences. So when we get to Unit 19, we'll do a nice side-by-side comparison. Another lender law is the Fair Credit Reporting Act. This is what gives us the right to check our credit report once a year. Do you guys do that? We need to do better about that, don't we? If you haven't checked yours in a while, I try to do mine in January. I don't think I did it this year. Maybe this January I'll do it. But it's not bad to check your report. What are the three? TransUnion, Equifax, and Experian. So it just kind of gives you an insight. This way, if you do go to apply for any loan, if there's something on it, you're going to be surprised. So better to find these things out now by checking. Usually the information goes back, the credit history goes back 7 years. Bankruptcies last 10. A question comes in about the dates for the act. Nah, I wouldn't know those dates. We don't need to know many dates. We got the lead-based paint date. That's a good date to know. The other thing that may affect the lender, the lending process, is loan fraud. Loan fraud is just bad. If you ever lie on your loan application, put false information out to try to obtain better rates, more money, etc., you could be looking at loan fraud. That's not a typo. That is fines up to $1 million and or 30 years in prison. Again, we're not the ones doing the loan application, but we're the ones working with the buyers. We're the ones that are front line with the buyers. Remember the other day when we were talking about the property appraised for less than the sales price? And the loan to value ratio is based on whichever amount is less. So if the property appraises for less, then that's what the loan is going to be on. And we either need to get your seller to drop the purchase price, or get the buyer to come up with cash, or have the two meet in between. One thing that the buyer won't be able to do is borrow the difference, because this lender's saying, well, you're trying to get a $200,000 loan to buy a house. I'm not going to let you take out a loan to borrow the difference. And that does include private sources. And private sources are the bank of mom and dad. So when bank of mom and dad say, I'm going to let you borrow money, the lender, through the ears of the lender, they just heard, you got to pay mom and dad back, right? If mom and dad want to gift that money, now the implication is it's a gift and you don't have to pay it back. And the question always comes up, whether mom and dad lie. Well, mom and dad have just committed loan fraud. So these are the kind of things that we may be around. We may hear some of these conversations. Things to be on alert for. Another consumer protection that we have is something called the North Carolina Predatory Lending Act. This just puts some limitations. It puts a ceiling on some loans, puts some regulations on the lenders. Again, it's so important that we understand that all lenders are different. They all have different terms. They all have different requirements. They all want different paperwork. Lenders are across the board, but they do have regulations. They do have limitations. We talked about the usury laws last class. Lending Act, Predatory Lending Act. I think one of the bigger things that have come out of the housing market crash is lenders are doing a better job of educating the consumer. Educating the consumer about their loan product. Their loan product, the terms of the loan. We talked about interest rate, for example. There's information now when you apply for a loan. They'll send you a little booklet, help educate yourself. We're going to talk a little bit more about the lending process when we get into Unit 21. Would this not apply to the market we're in? Oh, absolutely. Absolutely. Always. Now, whenever you're working with lenders and borrowers, lender laws are in. Just a brief mention, your book introduces you to RESPA on page 411. We said TILA was the cost to obtain the loan. RESPA is the cost of settlement. We'll talk a little bit more about RESPA in 21. So in the market we're in now, it's not that houses were overpriced. buyers were willingly paying more than asking price. It was that competitive. You had sellers with who knows how many offers. The buyers got to make their offer stand out somehow. So did some sellers overprice and take advantage of this market? Of course, some sellers did. But honestly, I think what drove up this market was buyers offering more than asking price, knowing it wasn't going to appraise, knowing going into it that they were going to have to make up the difference. Keep in mind too, you guys, that it's not just the purchase price. There are other terms of the offer that the seller needs to take into consideration. So due diligence, earnest money, that kind of thing. I told you guys about my list or my team's listing. It wasn't mine, but my teammates listing that had like 45 offers in 3 days. I mean, somebody had to win that one, right? Somebody's offer had to stand out. I don't know how much more than asking price, the winning offer. But there are lots of other terms. I had another teammate last year. His offer got accepted. The listing agent called him and said, "We accepted your offer." And he said, "I was a little surprised." He said, "It wasn't a bad offer. It wasn't a great offer, but it was a good offer." And so he was really surprised that theirs got accepted. And the listing agent said, "Do you want to know why we picked you?" And he said, "Yes." Evidently, she had put something in agent only that said the seller requires this form when you submit the offer. And I don't know what the form was, it's not important, but the seller requested something. And of all of those offers, he was the only one that followed the instructions. He was the only one that did what the sellers. And so he wasn't the best priced offer, but the sellers felt that he was the easiest to work with because he followed the instructions. Isn't that something? So the sellers can choose any offer they want to. It doesn't have to be the most expensive. Do cash offers usually prevail when there are quite a lot? Cash is winning. Investors are those with cash typically are investors, and they're they're definitely winning. So let's what questions do I have on 15? Let me pause there for a second. We're getting ready to get into the math. Actually, we're getting ready to take a break and then we're going to get into the math. So what do we have any questions? Question comes in, is there a way to make just the interest rate assumable, or is the buyer responsible for the whole bundle? It's a package deal, so it's this loan. And when you assume, I should say, when you assume this loan, you're assuming all the terms. So yeah, it's going to be a bundle deal. So let's go ahead and take a break. Midterm is open. No, it's closed book. We're treating this like a real test. So thank you for the reminder. You guys got a midterm in your inbox that's good until midnight tonight. So if you haven't done that, please make sure you do. Closed book, treat it like a real test. Yep. So let's go ahead and take our break. We come back, we're going to look at some of this math in unit 15. So let's take 10.
You said we had a closed test?
I'm sorry?
You said we had another test?
No, the midterm.
Oh, okay. I thought we had another one. I was excited.
Well, you do at the end, but not for now.
Okay.
Keep going and learn, test, pass. There's all sorts of good tests in there.
Yes, there is. Thank you.
Good, of course. attendance. Gotcha. And we're going to start talking about some of this math for Unit 15. So if you guys will, before we really get into it, if you guys will, in your book, turn with me to page 412 and 413. 412 and 413. So some of the math that we're getting ready to do involves this mortgage factor chart. Let me go ahead and say this. You guys do not have to memorize this thing. Don't worry about that. But you do need to know how it works. If you're asked to find the mortgage factor, I've heard some students at PSI Testing Center say this thing is a big chart on the wall. So you may be asked at PSI, this won't be for my exam, but you may be asked at PSI to find the mortgage factor. So first off, let's make sure we understand how the chart works, and then we'll talk about what it all means. So on page 412, you guys see the first column there is rate. Does everybody see that? That's the interest rate. So when we see rate in lenders' terms, that's our interest rate. And then all the columns after that are the term of the loan. Is it a 10-year loan, a 15-year loan, a 20-year loan, 25, and 30? So the lender uses this mortgage factor chart based on the proposed interest rate, the projected interest rate, and the term of the loan to help the borrower find the mortgage factor. Mortgage factor can also be referred to as a rate factor. So mortgage factor or rate factor. What this number does, once we find it, is used to help the lender determine your monthly payment, your monthly debt service. So remember back in Unit 14, we learned how to amortize monthly, and they gave us the monthly payment. In the event that they don't give us the monthly payment, then they either have to give us the mortgage factor to plug into the formula that I'm getting ready to introduce you to, or again, give you the chart. So let's say you're at PSI and the problem tells you that it's a 5% interest rate and it's a 30-year loan. Tell me in a private chat what the mortgage factor would be, or what would the rate factor be? It's a 5% interest rate for a 30-year loan. What would your, and watch your lines, it's easy to get. What would the mortgage factor be? 5% interest rate for a 30-year loan. Again, they're either going to give you this number or they're going to give you the chart to find this number. And I want to make sure we know how to find it. We'll talk about what we're going to do with this number in just a second. So the 5% interest rate for a 30-year loan. And it looks like we're pretty good. So in the first column, take your finger and slide down till you get to the 5. That's your 5% interest rate. And then slide over to the right to the very last column. And we learned that our mortgage factor is 5.37. So now that we know that, what are we going to do with it once we find it? And what that number helps us do is help us find your monthly debt service, your monthly principal and interest. So if they don't give that to you when you're amortizing, if they don't give that to you, when you're figuring interest over the life of the loan, then they'll have to give you either that rate factor or how to get to it. So to find your monthly principal and interest, your monthly debt service, please, everybody, note the word monthly. I think a common error is you find the answer and then you divide by 12, thinking that you found annual. So when we do this, what we're solving for is your monthly principal and interest. Please make sure you make a note of that. And we're just going to take the loan amount times the rate factor and divide it by 1,000. We need to know the formula. I've yet to figure out the T-bar on this one, but we need to know the formula. Thank you for telling me you're back from break. The best way I have for you guys to memorize formulas, put this on a flashcard. If you don't know the formula, you don't know what to do with these numbers. So let's just say, for example, and I think I have one for us to work. Yeah, I got one for us to work together, or you guys. But let's just say, for example, the problem tells you that the loan amount is 100,000. The problem either gives you the rate factor or it tells you where to find it. So it tells you in this case, the rate factor is 8.78. And then we need to know to divide by 1,000. We know that because we know the formula. So it's just 3 quick steps. You take 100,000 times 8.78. You get 878,000. And then just divide by 1,000. So what is this person's monthly P&I payment? What is their projected payment using the rate factor? It's going to be $878. Again, please note the word monthly. Questions before I turn you guys loose and let you do one? Everybody have the formula written down? That's key. Okay. So here's one for you guys. If you will, let me know in a private chat. Give me a few more seconds. Okay. So let's see what we got here. What do we do when we first see a math problem? What's the very first thing we do? Pick your calculator up, start doing something with all the numbers that you see? No, just read it. Just read it. Take a few minutes, sit on your hands if you have to, but just read the problem. Isn't that good advice for all these test questions? Just read it. So the Millers are borrowing $350,000 at 4.5% annual interest for 30 years. Using the mortgage factor chart, it is determined that the mortgage factor is 5.07. What will the Millers' monthly debt service be for this loan? If we don't know the formula, we don't know how to rule out the distractors, do we? If we don't know the formula, we're trying to do something with the distractors. What's the distractor? The term and the interest rate. That has nothing to do with the formula, does it? Guys, please remember, knowing the formula is like 80% of the battle. Okay. So the formula tells us to find our monthly principal and interest. We take the loan amount. They're getting a loan for $350,000, and they give us the rate factor of 5.07. So again, either they're going to give you that or they're going to give you the information you need to find it. And then the third piece of the formula, loan amount times the rate factor divided by 1,000. So we take 350,000 times 5.07. 5.07. We get like 1,774,000. Do you want this for your mortgage payment? Not yet, right? So now we divide by 1,000 to get a mortgage payment we can afford. $1,774.50. Good, good, good. I guess that's my question to you. If you didn't get it right, do you see where you went wrong? So that's good. Again, know the formula. I don't know how you're going to memorize it. Put it on a flashcard, write it down 20 times. Have you guys, the repetition of writing will help solidify it in your brain. Did anybody else ever get in trouble in school and have to go to the whiteboard or the blackboard and write? Like mine was always, I had to write 100 times, I will not talk in class. So maybe you had to do that. Maybe you won't throw spit wads, whatever your thing was. Why did they make you do that? It was punishment, of course. But if you wrote that down 100 times, were you less likely to talk in class again? Were you less likely to throw spit wads the next time you had the urge? So it's that idea of repetition that's going to make it stick. So let's see. I got a few things in the chat. The difference between the interest rate and the rate factor. The rate factor is the mortgage factor, is what the lender uses to determine what your monthly payment's going to be. And your monthly payment consists of two parts: principal and interest. So interest is figured, the interest rate is figured, but the mortgage factor or the rate factor lets the lender determine what your monthly payment is. Somebody did it different, but you got the same number. Perfect. Again, all you're going to have to do on a test is show me A, B, C, or D. So as long as you get the right answer. Can I erase this? Everybody good? Speak now. Not. I did have a request. Go back and look at the formula again. So there's that. Just the loan amount times the rate factor divided by 1,000. Put it on a flashcard. Write it down 100 times. Whatever you got to do to get that. Loan amount times the rate factor divided by 1,000. Questions? Okay. The second piece of math, we're going to have a conversation about. The second piece of math in Unit 15 is qualifying a buyer. So before you guys start writing, please hear me out for just a minute. I'll leave the screen up for a long time. You'll have plenty of opportunity to write it all down. You're not going to find qualifying a buyer math in your textbook. It is in the syllabus though. So what do we know? If it's in the syllabus, then it's a good candidate for your state exam. I'm in a really good mood today, so I'm going to tell you guys, you are not going to see qualifying a buyer math on my exam. There's your present for the day. You're not going to see it on my exam. You may see it on your state exam, and I stress the word may. If you're one of the lucky few that gets to see it. I have decided, because we're not going to see this on our end of class exam, we're going to go through the basis and the general, but as far as getting into formulas and doing it, I'm not going to do it today in class. I think our time can be better used to prepare for things that you will see on my end of class exam. What I will do is I have this section recorded from a previous class. So I will put this section in our YouTube channel. You guys make yourselves a note right now. When you're getting ready for your state exam, go to the YouTube channel and do qualifying a buyer math. But we're not going to worry about the math until we're ready for our state exam. And of course, I'm always around to help. I do not disappear when we're done. So if you need questions, if you get stuck. Is everybody good with that? We're just going to introduce you the basics, let you know how it works. And then you can do that math. Again, same style that we do in class. It's just a recording from another class. Do I have any concerns, or has Julie lost her mind or anything like that? I just would rather spend our time going over things that I know you're going to see versus things that I think you may see. Is everybody good with that? My game plan? Okay. So let's talk about what these numbers mean. We met these ratios a few pages back, and this piece is important. I do think this is important when we understand what we're looking at with these numbers. In order for a lender to qualify a buyer, the buyer has two ratios to consider. And in order for the buyer to get loan approval, they have to qualify under both ratios. So the two ratios look at two different things. Let's talk about the 28% first. The 28% ratio looks at the borrower's housing expenses. The lender defines housing expenses as your PITI, principal and interest, taxes and insurance, a 1/12 of your annual taxes, and a 1/12 of your annual insurance. The lender considers housing expenses HOA dues if applicable. If the property's in an HOA, they got to take HOA dues into consideration. If it's not, then we don't have to worry about it. The lender also takes into consideration if it's a conventional loan with a loan to value ratio of 80% or higher. The lender will charge PMI, private mortgage insurance. So PMI is a charge on conventional loans when the loan to value ratio is higher, 80% or higher. Guys, when it comes through the eyes of the lender and they talk about housing expenses, these are the only things that they're talking about. PITI, HOA dues if applicable, PMI if applicable. This is what that 28% means. The lender says, let's pretend that this entire pie, y'all know I like to talk about pie now, right? This entire pie represents your monthly income. How much money do you have coming in every month? If you have a significant other, they will take your significant other's income into consideration as well. So the whole pie represents your household monthly income. And what the lenders say is that they can allow for 28% of your income to go towards housing expenses. So when they're trying to decide if they want to approve you, they're looking at your income, your projected PITI, HOA dues if applicable, PMI if applicable. If the three together are more than 28% of your monthly income, then you're not going to get the loan. You've gone out of the 28%. The second number then is your 36% that you have to qualify under, the borrower. The 36% looks at housing expenses. What do we just define as housing expenses? PITI, HOA dues if applicable, and PMI. In addition to your housing expenses, the 36% is also going to look at your reoccurring debt, car payments, credit card bills, medical bills, student loans, alimony, child support, whatever those bills are that you pay every month. Did I hear a question? So they look at your housing expenses, and then they look at all your recurring debt. And then again, they look at pie. And they say, of your total monthly income, they will allow for 36% for housing expenses and recurring debt. In order to qualify for a loan, the borrower has to qualify under both. which means their housing expenses have to be less than 28% of their income. Their reoccurring obligations have to be less than 36% of your monthly income. Let's talk this through for a second. Why do they care how much you put into housing expenses and reoccurring debt? Let's look at this list. Guys, we haven't eaten dinner yet, have we? We haven't put gas in our car. We haven't paid a utility bill, internet, save money for vacation. What if your water heater goes out? They put restrictions on the qualifying ratios, the 28 and 36%, because they figure that's a good piece to start with. If you're putting 28% just in your housing expenses, that only leaves you with the rest to do everything else. If you're putting 36% in your housing expenses and your reoccurring debt, that leaves you the rest of your income to go to the grocery store, to put gas in your car, to pay your power bill. That's exactly right. They want to make sure you're not going over your means, because at the end of the day, remember what the lender cares about. Can they afford to pay me back? And if you're paying more than your 28 or 36%, you can. So part of the lender's process is, again, to crunch these numbers and make sure they fall within these ratios. So let's say, I'll be honest with you guys, as a whole, in this country, this is the one that hurt. That was a terrible line. Let me try that again. This is the one that hurts us, is our reoccurring debt, our reoccurring obligations. And this is the one that is most people, if they're not going to get loan approval, it's because of their reoccurring debt. So the lender's going to say, you've got to do two things. You either make more monthly income, gee, don't we all wish, or pay off some of that debt. Again, if they don't qualify for both, then they're not going to qualify. If they have a lot of debt, a good lender will work with this buyer to help them get that paid down so they can buy a property. Maybe we consider a smaller purchase price, a lesser purchase price, which would get them a lesser PITI payment. They'd have a smaller monthly payment, for example. So just because they may not qualify doesn't mean it's over yet. Do you have any questions on the, we'll call it income pie and the 28-36% ratios? So like I said, does this apply for other types of loans? That's a great question. And I do not know the answer to that. I do not know the ins and outs of a car loan or, any kind of loan. This is specific to mortgage loans, particularly conventional loans. FHA, yeah, FHA has their own set of numbers. Go back to page 408. So the conventional is 2836. FHA is 3143. So in an FHA, you can apply more of your monthly income to housing expenses and housing expenses plus recurring debt. And then VA loans are calculated a little bit different. So they only look at one number, 41%. And what they're doing is looking for your residual income. So they're looking at everything, one big picture. They don't break down VA loans. Thank you. If you see this math, again, we're getting ready to move on. If you see this math on your exam, I'm like almost certain they will give you the 28-36%. But in the small chance I'm wrong, it will be a conventional loan. You may just want to know 28-36%, but I'm almost certain they would give you that. As I mentioned, you're not going to find this math in your book. So you will have the video. You guys all made a note when you're getting ready for your state exam to go through the video. You're also going to find some qualifying of bio math and learn test pass. You're welcome to learn it now. My suggestion is you put it off to the side, knowing you're not going to see it on my state exam or on my end of class exam. One less thing for you guys to worry about right now. I feel like you guys have enough on your plate. Would you agree with me? So, okay. Questions?
Hey, Julie.
Yeah.
So were you saying that we won't see on your exam the qualifying debt ratios or that plus the mortgage factor chart?
You may see something about the 2830s for like what's a housing expense, what qualifies for the housing expense. So
Okay,
that's why I do want to go through this part. But as far as the math goes, you're not going to see this on my test. Good news
Okay.
is you can do this math with a T-bar. And starting here is what I'll put in our YouTube channel. You guys all have a note that says go to Julie's YouTube channel when I'm ready for my state exam. And you'll know to find this.
Okay.
Yep. Thank you. What other questions do I have? I need to stop sharing just for 1 second. So, I closed my PowerPoint out. So key point review in unit 15 was in the very beginning of the unit. Your key terms are back on page 389. Got to go off PowerPoint. 389 for your key terms. Key point review is at the end. It starts on page 414. And then you got the quiz for unit 15 on page 417. This officially gets us through our financing units. So we can take our lender hat off. I do think I will share with you guys, students tend to struggle over the financing units. I think a lot of it comes down to two reasons. One, you had no idea you're going to think like a lender when you signed up for this class. So it's just not what you were prepared for, not what you were expecting. I think the other piece that is the struggle, it's a whole new language. You guys are still trying to speak broker, speak agent, and now all of a sudden we're throwing lender into the mix as well too. So when it comes to units 14 and 15, when it comes to the financing units, I direct you to the key terms. Start with knowing what the words mean. Y'all remember you got a glossary in the back of your book. You got an index, but I think the basis of these units are knowing what the word means, starting with. And then use your quizzes. We've talked before about how I like the key point review, kind of use it as a checklist. You can go through it. I know this, this, and this. I don't know that. That means look it back up. And you got quizzes as well to help you navigate that. Okay. Questions? Real quick, while we're all here, while we have everybody, don't forget, you guys, we have, or we do not have, class next week. We get a break from each other. No class next week. Now, for you guys, I hope you don't interpret next week as like fall break, whoop, whoop, because you know what's in 4 weeks from today? Have y'all looked at a calendar recently? 4 weeks from today. So we take a week, we take a week off. I think I just got cussed out. We take a week off and then we're down to 3 weeks. Okay. So I think you guys should use this time off to get yourself caught up. Get yourself caught up on what we've covered. We're getting ready to get into unit 21 in just a minute. Look ahead. These next couple weeks are going to go by pretty fast, you guys. I'm being very honest. This May or may not be your first time through pre-licensing, but it's not mine. So this is kind of where we go, the downhill from here. I do want to remind you guys, and I want to address this because I usually get a couple panicked phone calls or emails or something. You guys have this tentative schedule in Learn Test Pass. And, you know, so after 21, we'll start that today and we'll finish that next week. I'm not worried about the time. Y'all don't need to worry about the time either. That's my job. And as of right now, I'm not worried about time whatsoever. But then it looks a little intimidating because then we start ripping through them 17, 31, 11, 12, 19, 18, 16. Guys, there's not near as much information in these last few units as what there was in agency and contracts. So remember the first 6 units we got through pretty quickly because there wasn't just a lot of information, wasn't a lot of testing points. That's where we're heading with units 13, 11 on to 16. Some important things that we need to know, of course, but we're not spending as much time or detail in those units as what we did. I mean, we spent the better part of 3 classes in unit 7. So I feel like the middle of the class is the bulk of the material. 7, 8, 9, and 10, financing, etc. When you guys look ahead, y'all, unit 18 has like 5 pages. Unit 16 has like 6. So I just don't want you guys to panic looking at all that we're getting ready to do. We'll blow through 18 and 16 in, you know, like an hour, hour and a half. Does that kind of help alleviate concerns? The other thing I want to remind you about, in Learn Test Pass, we have the Relink book. This is your real estate licensing in North Carolina. And please remember on page 16, again, it gives you the breakdown of the topics and how many questions you can expect to see on each topic. So again, as you can see, property management, landlord and tenant, you'll see a few questions, 4, but it's nothing like what we saw in 7, 8, 9, and 10. So I say all this to try to help alleviate stress. Remind you guys to trust the system. We've been through this. Lane and I, we got this. With that being said, 4 weeks from today is your test. So I encourage you to use our week off to your advantage. So you can help get yourself caught up. So we can finish out when we get back. November 2nd, is that when we come back? I think so, whatever that Tuesday is. Do you have any questions or comments? I did get a question on the cram courses. I will record mine on that Saturday and put it in our YouTube channel. I don't know if Jane will record hers or not, but Jane does have a recording of her cram course and Learn Test Pass down here at the very bottom. So the very last thing is Jane's cram course. I still think in person is the better experience, but we also understand conflicting schedules. Remember, the cram courses are not required, they're optional.
Did you say we'd be able to take this exam in person or no?
Our exam is in this format. It's online. Yep. We'll talk about the rules and expectations of my exam, the very last thing we do. Guys,
Okay.
please remember in the email you got from Lane that you use to access this class every day, your exam will be delivered in a platform called ClassMarker. So Jane has, I can't draw today, Jane has recorded a ClassMarker tutorial. If you have not watched this yet, please do so. It'll introduce you to ClassMarker. This is another good reason for you guys to take the midterm because it's delivered in that same format. So it'll give you an idea of what to expect. So you guys will log on to Zoom on test day like you always do. So I can watch you. And then you'll take your test on ClassMarker. And again, the last thing we do, we'll talk about the rules and expectations in my exam, but I'm not going to do them now because then we'd have to do them again. So we'll just wait and do it all at the end. Other questions about anything? It's kind of open forum for a minute. While we take a big deep breath.
I have a question.
Yeah.
If it gives us, say that person's, if a question, I'm sorry, let me start over. If the problem gives us a consumer's monthly income and their debt, and then they ask us to figure out if they're going to qualify based off the ratios, are we dividing that debt by the loan amount or by the income amount?
You take their expenses, that's exactly it. Their expenses divided by their income. Yep. So monthly expenses divided by monthly income.
And that'll give us
Expenses are either housing expenses or housing expenses plus reoccurring debt.
Okay.
So you got to do it twice. Once under the 28 and again under the 36. Yep.
Gotcha. Okay. Thank you.
Of course. Anything else? Okay. Y'all ready to go to closing? Man, we've been building up to this. Let's go to closing. We are going to get into Unit 21. And in Unit 21, we actually get to go to closing. Whoops. A question comes in if the lender's a private source, a private business. That's why, guys, we say all lenders are different. There is no across the board lending practice. As a buyer's agent, the very best thing you can do is encourage your buyer to talk to several lenders. Encourage them to talk to a couple so they can shop around and they have something to compare and contrast. Never, ever, ever look at a buyer and say, this is the lender you're going to use. You don't know what's best for them. There's not a 30-year commitment. That's a long time. Have any of you been married that long? That's a long time to be in a relationship with somebody, isn't it? And then that means being with your lender. Don't they have that right to know the terms? Don't they have that right to shop around? Isn't that why we date before we get married? So you can date, shop around lenders, encourage your buyer to pick out the one that's best for them. Okay, so Unit 21, we get to go to closing. Eventually, we're going to walk through more through the contract to closing process, particularly for the buyers and their due diligence period and things that they should consider doing. Talk more about the loan requirements, that kind of thing. So in Unit 21, we're going to talk about these pre-closing procedures, the things we need to do to get ready for closing. We're going to explain more about TRID and RESPA. And then the last thing we do in Unit 21 that we will not get to today, but we will start with when we come back together in November, is we're going to help our buyers figure out how much they have to bring to closing. So we're going to help our buyers consider all of their debits and all their credits. So bottom line, we can help them calculate their final numbers. We'll have information for sellers as well. But your test questions, both on my exam and your state exam, is going to say, how much does your buyer have to bring to closing? So we'll talk about, before we leave today, we'll talk about what you guys can work on this next week to get you ready to do the math at the end of Unit 21. So. Let's talk about this contract to closing process. When I'm working with buyers and sellers, but particularly buyers, because they have more to do, I tell my buyers to think about the contract to closing process as working gears. So let's put every person involved in the contract to closing process, let's give them a gear. So for example, one gear is going to be the listing agent, the seller. Another gear is going to be the buyer's agent, the buyer. We got a gear for the lender. We got a gear for the attorney. We got a gear for the appraiser, home inspector, pest inspector, surveyor, all these people that have to work through this contract to closing process. It's a process. Hear me say that. It is definitely a process. What happens if one of these gears stops? What happens if one gear stops? Don't they all stop? Guys, this is a huge part of our job, is keeping these gears going, making sure that buyers are doing what they're supposed to be doing, that they're communicating with the lender, that we got the home inspection order, that the lender's ordering the appraisal. A big part of our job is keeping these gears going. You guys are going to have to keep up with dates. You're going to have to keep up with due diligence dates and settlement dates. Your buyer's not going to call you and say, our due diligence is up today. You got to be the one to keep up. So, of course, I recommend, some kind of calendar, some kind of system, so you can keep up with everything, again, to keep the gears going. Good. So we briefly, when we were in Unit 10, we talked about closing. We talked about the difference in settlement and closing. If you guys will, look in your page on your book on page 518. It pulls out from our standard contract that we looked at back in Unit 10. It reminds us the difference of settlement and closing. Settlement is when we all go to the attorney's office. Buyer and seller sign everything. Buyer brings money that they have to pay to close. If the seller owes any money, then they bring that to settlement. Once the attorney gathers everything that they need from buyer and seller, you and I leave the attorney's office, and then the attorney proceeds with closing. So closing is putting the finishing touches on everything. The attorney's going to do one more quick title search so they can offer their opinion to the title insurance company. We talked about that back in Unit 5. The attorney's going to collect funds from the lender. We'll talk a little bit more about the loan process. And the very last act, the very last thing to happen, the last thing the attorney does at closing is to record the buyer's new deed. Then and only then is it a done deal. It's not a done deal until that new deed gets recorded. That's when the buyer should be given access to the property, keys, gate codes. They should not be getting access prior to that deed being recorded. Some of you may have a personal experience or know somebody that got keys when they left the attorney's office. That's why I say they should not be given access until that deed is recorded, because then and only then is it theirs. It's still the seller's property. I mentioned earlier I have two favorite emails. My second favorite email is clear to close from the lender. That means we have loan approval. My first favorite email in this industry is from the attorney or the paralegal that says, "We are on record." That's when you celebrate. That's when you go to the attorney's office and get your check. That is when it's done. So "we are on record" is my favorite. Clear to close, because you know what I need before we can record? I need a clear to close. They all work together. So let's talk about some pre-closing procedures. Let's talk about getting there. The buyer hires the closing attorney. The buyer hires the closing attorney, which means the closing attorney represents the buyer in the transaction. The buyer is the closing attorney's client. If the buyer comes with a lender, the attorney will also work in the best interest of the lender as well. If it's a cash buyer, no lenders around, no lenders involved. Sellers may choose to hire their own attorney. Anybody's always welcome to have their own representation. In most typical residential transactions, the sellers will allow the buyer's attorney to process their paperwork as well. If you get into commercial transactions, for example, both parties are usually represented. They have their own attorneys. Estates, usually the seller, the heirs come with an attorney. But in a typical residential transaction, the buyer hires the attorney. The attorney has a job to make sure that that new deed that they record for the buyer when this transaction is all said and done is a good deed. The attorney has the job to make sure that what they're giving their buyer client is a clear, marketable title. This is why the attorney does the very thorough title search. If the attorney finds anything with the title, they will get with the seller to clear it up before settlement. That's their best interest for their buyer client. So if a buyer asks a listing agent for a recommendation, is it acceptable for a listing agent to offer suggestions? I guess so. If I were the listing agent, I would wonder why that buyer's not calling their agent, why they're calling me. But maybe to your point, if you're asking me something else, I apologize. But as with lenders, we're always going to have our buyers shop around. Never, ever look at a buyer and say, this is the attorney you're going to use. You can always say, here's a list of 2 or 3 attorneys that I've used in the past that I've had a good experience with. If you're new and you don't know attorneys yet, your firm may have a preferred vendor list. So you can say, here's a couple list of attorneys that my firm has used. You don't have to tell anybody you're new. Here's a couple attorneys that my firm have used. Most people don't know closing attorneys. But the point here, you guys, don't send them to Google. Don't tell them to find an attorney. You know what results Google can give sometimes. So based on your personal experience, your recommendations, and you will form relationships with attorneys. I'm telling you guys right now, there's nothing more valuable than having a relationship with an attorney and having one of them on speed dial. So if you got a quick question, same thing with a lender, home inspector, you'll start forming all those relationships. Can the buyer use the seller's attorney? Sure. If the seller has an attorney, could the buyer choose to use the seller's attorney? Absolutely. That attorney's kind of acting like a dual agent now, aren't they? They're representing both. Again, anybody's always welcome to bring their own representation. So the buyer's agent, you present an offer on behalf of your buyer, and you guys negotiate and counter, and you come to terms, and everybody signs, communication of acceptance crosses the line, and yay, we're under contract. I'm all about doing the small celebrations in between that big up we're on record. Once we go under contract, the buyer's agent needs to first send a copy of that contract to the lender. The loan process is the longest part of the contract to closing process. So get a copy of that contract to the lender so they can start their thing. And then the buyer's agent needs to get a copy of the contract to the attorney and go ahead and schedule settlement. There are delays in settlement. They're very common. We can always reschedule, but getting something on the calendar now gives everybody that date, that agreed upon date in our contract to work towards. So I hear you guys. Julie, when do I get paid? When do I get my money? I hear you. We collect our payment from the attorney when it's a done deal. And it's not a done deal until that buyer's new deed is recorded. You'll generally go back. Some attorneys close or record like once a day. Some may do it a couple times a day. They're all different. So whenever it's recorded, you'll go back to the attorney's office, get your firm's check, take it to your firm so they can process and pay you. That's exciting, isn't it? We like that piece of it. We are on record. So let's back up. Before we can get to closing, we need to back up and talk about the contract to closing process. This is straight from page 519 of your book. 519 over to the top of page 520 are straight from our offer to purchase and contract. That's why it's italicized. It's straight from our offer to purchase and contract. So you can go to unit 10 and look at the contract, or you can look here. But it gives us an idea of the things that the buyer should be encouraged to do during their due diligence. They don't have to do much. For example, we'll talk a little bit more about this after break. If they're getting a loan, the lender will require an appraisal. Period, end of story. If they're a cash buyer, though, the appraisal is optional. Some lenders may require a home inspection, but for the most part, the home inspection is up to the discretion of the buyer. We talked about if it's a VA loan, they'll require the pest inspection. If it's a conventional loan, it's up to the option of the buyer. All we can do is encourage the buyer to do investigations and inspections to learn as much about the properties they possibly can. Because guys, remember, they have through their due diligence period to decide in their sole discretion whether or not they want to move forward with or terminate during due diligence. So as a buyer's agent, making sure they understand the importance of inspecting and investigating so they can make that decision to move forward with or terminate the transaction. Questions so far? It looks like it's break time. So let's take 10. If you have any questions, please don't hesitate. We come back, we're going to go through the buyer's due diligence process, the things that we should encourage them to inspect and investigate. So let's take 10. back. So cameras.
That went
are-
by way too fast.
It does. That's not even when I set a timer. Just so we know we all have, because sometimes it goes by fast, sometimes it goes by slow. I hear you. You guys hear all that? Okay. I don't know what they're doing upstairs. The fun of hotel life, I guess. All right, so I am taking screenshots for attendance. And we are going to jump back in. And again, what we're going to work on now is talking specifically about the buyer's due diligence process and the things that they may consider. Understanding all buyers, all properties are different. Thank you for telling me that you're back. I have taken attendance. So starting on page 520. What we're looking at the start of 520, basically the italicized that we saw on 519 and 520 from the contract, we're going to kind of break that down a little bit more starting on page 520. As I've mentioned, please understand, the loan process is the longest part of the contract to closing process. So buyers agents, we got to keep those gears going, which means we got to get that contract to the lender as soon as we go into contract so they can start their thing. I also think it's important that we have a conversation with our buyer and let them know the importance of communicating with the lender. So if the lender says, I need this form, or I need, something from your employer, or I need to see your bank statements for the last 2 years, get them working on that, because the lender can't move on with their process until they've collected what they're asking for. The other thing that I really want you guys to see, this tends to be a source of confusion. I'm not sure so much for your test as it is in real life, especially those of you that knew what it was like to buy a home in the past. Today, there is no loan contingency. Remember, we talked about what a contingency was. A contingency says, I don't have to perform if this action doesn't first happen. I don't have to do B if A never happens. So in a loan contingency, basically what the buyer's saying is, I don't have to buy your home if I don't get loan approval. Our contract does not have any built-in contingencies. Do your head one way or another. Can the parties agree to add a contingency? Can buyer and seller agree to add a contingency that might say, for example, if I don't get this loan, then I can't buy your home? Can they agree to do that? Absolutely, because anything is negotiable. What I need to make sure we all understand is it's not automatic, it has to be added. The other thing I need you guys to understand is I don't have a form for a contingency. So if buyer and seller agree to a contingency, what do we have to have them do? What has to happen? Am I going to draft it myself? No. That's right. If they want to add a contingency, we do not have a pre-printed form. So we got to call somebody. And in this case, we're calling the attorney. You guys, please remember, I cannot draft legally binding verbiage, even at the instruction of my client. Your buyer, guys, we're a heck of a lot cheaper than attorneys, aren't we? Your buyer will look at you and say, can't you just draft that for me? And your answer is always what? No, we cannot, even at their instruction. So no contingencies, and that does include financing contingencies, loan approval. The buyers should be encouraged to do investigations. I think the best place to start, the best inspection to start with is their home inspection. The home inspector is The home inspector's job is to go in the home and find all the problems with the home. Please prepare your buyer for this. They're not going to get a report that tells them how lovely the house is that they're getting ready to buy. They're going to get a report that tells them all the problems. That's the home inspector's job. I tend to think of the home inspector as like your general practitioner. You go to the doctor for your annual checkup. If your general practitioner finds something that causes alert, something to throw up them a red flag, don't they send you to a specialist? Don't they send you to another doctor to investigate further? That's kind of what the home inspector does. The home inspector will say, there's an issue with the electrical. My recommendation is that you talk to a certified electrician. There's a problem with the plumbing. My recommendation is you talk to a plumber. You guys with me? They know a little bit about a whole lot of things. Their job is to find problems. But as far as diagnosis, they may need to, as part of their due diligence, they may want to reach out to that electrician to go in and inspect it and investigate it. Question comes in, how would a buyer start the loan process before finding a home? That's where the pre-approval and the pre-qualification come in. So before we have that property, that's where we can get the pre-approval or the pre-qual from the lender to make sure that they can afford, y'all don't show them properties until you know how much house they can afford. Don't waste your time or theirs. All of the property investigation is done at the buyer's expense. The buyer pays for their inspections and investigations. It's known as their due diligence costs. Another thing we need to get our buyer working on early in the process is homeowners insurance. For me, once I get the lender's first round of criteria satisfied, I get my buyer shopping for home insurance. I always have them shop around. Again, not all home insurance agents are created equally. So have them shop around, have them talk to a couple different insurance agents so they have something to compare and contrast. Tell them to call Jake from State Farm. Tell them to call Flo from Progressive. Have them shop around so they can see which insurance program is best for them. If the buyer's getting a loan, homeowners insurance is required. It's how the lender protects their interest. If it's a cash buyer, homeowners insurance is highly recommended. Also required if they're getting a loan is the appraisal. Again, the appraisal is actually the property of the lender. The lender is the one that requires the appraisal because they want to know what to issue the loan off of. Remember the loan to value ratio, and through the eyes of the lender, value is determined as the sales price or the appraised amount, whichever one is less. So how do we have something to compare if they don't have the appraisal? So the lender requires it. If property of the lender is for them, the buyer gets to pay for it. But it is so the lender knows how to originate the loan. We should encourage our buyers to have a survey done. We talked about the survey. We talked about our meets and bounds back in Unit 4. Survey is the only way to help the buyer identify encroachments, easements. If it's a condo, obviously, we don't have any land to survey. Possibly with a townhome, maybe, I guess it depends. But if they're buying a single family home or any home on land, a survey should be required. Unless they're in a subdivision, they can use that plat map if available. If the property is on an on-site septic system, the buyer should be encouraged to have that tested as part of their due diligence. If it's public, obviously we don't have to worry about it. If it's unimproved land, we haven't built on it yet, and it's not going to be eligible for public sewer, then part of your buyer's due diligence is going to be to have a soil suitability test. to see if the land will perk. It's referred to as a PERC, P-E-R-C test. The PERC test will determine if the land will support an on-site septic system. If they think your buyers are gonna buy this land to build and we can't connect to public sewer, part of their due diligence would be to make sure that they can have on-site. You guys remember how many human heartbeats per bedroom? The septic system, human heartbeats per bedroom, y'all remember? Yep, 2. So the improvement permit just tells us how many people this on-site septic tank will support. Again, if your seller doesn't have an improvement permit or a septic permit, then they can call the health department of the county where the property is located, and they can issue a permit. Wood destroying insect report is what we've been referring to as the pest inspection. We say it's a pest inspection, but specifically they're looking for pests that destroy wood, termites, carpenter bees, powder post beetles. Your home inspector and your pest inspector will look for evidence of other pests. And if they see some, of course, they'll let you know. But the pest inspection that we refer to, again, is particularly looking at wood destroying insects. Flip over to page 522. 522 with me real quick. This is a sample pest inspection. Again, what the pest inspector is doing is looking for evidence of pests. Maybe they see actual pests, maybe they see evidence. Yes, I see a hand. Ariana?
So going back to the last slide, insurance and appraisals are required by the loan, but the surveys are not required by the loan.
Correct.
Okay, thank you.
Correct. Sure. Thank you. If the lender has concern about the land, whether or not it's in a flood zone, for example, then they may require it. But for the most part, that's going to be up to the discretion of the buyer. Yep. Uh, 523, we talk about repair and improvement negotiations. Y'all do your head one way or another. Does the seller have to do any repairs? Do they have to fix anything? No, they don't have to change a light bulb if they don't want to. Remember that very important sentence in our contract that says this property is being sold in its current condition. So we're good. The seller doesn't have to fix anything. Next question, show me with your head one way or another. Can the buyer request repairs? Can they ask the seller to fix? Sure. There's no rule that says they can't ask. The seller could agree to do all of the requested repairs, none of the requested repairs, possibly some of the requested repairs. Once your buyers had their inspections, home inspection, pest inspection, survey, etc., they are encouraged to, if they want to ask for repairs, we're encouraged to do all this, negotiate the repairs, come to agreement, if any, all while we're still in due diligence. Because if the buyer has a home inspection and they come away with a 60, 70 page report, whole 60 pages of things wrong, and the seller says they're not going to do any repairs, we're still in due diligence. The buyer has a decision to make. Now, knowing what I know, do I want to move forward with or terminate this transaction? If those repairs add up, if your buyer, we found structural issues, electrical, plumbing, the roof is 20 years old. If all those repairs start adding up, the buyer may find it that they want to terminate and get their earnest money back. They have to decide, now knowing what I know. And if the seller agrees to do any repairs, we need to have everything in writing and signed while we're still in due diligence. If the seller agrees to do any repairs, we're amending that one sentence in our contract. This property is no longer being sold in its current condition. Now the property is being sold with the expectation that the seller fixes this, this, and this. I think the other thing that's important to remember, can they counteroffer? Of course. It's round 2 of negotiations, we'll call it. So can we counter? Can we go back and forth? Oh yeah, until we come to terms. I think the other thing that's important for us, and particularly our buyers, to understand, y'all ready for some mind-blowing information? Brace yourself. You ready? There is no such thing as a perfect home. All homes have problems. So if your buyer says, oh, there's a problem, I'm not going to buy this house, then what house are you going to buy? Are you guys with me? I think if we can set those expectations, have these conversations. I mean, if you're buying a home that was built in the 50s or 60s, they built things differently back then than what we do today, for example. So just prepare them. And the other thing about that 60, 70-page home inspection report I just mentioned, a lot of our home inspectors use lots and lots of pictures. So it's not like I got 60 pages of problems. I got 60 pages of pictures of problems. And that takes up more room on that home inspection report. The buyer's right to terminate during their due diligence, guys, that's what they pay the seller for. That's what the due diligence fee is all about. The buyer's paying the seller for the right to terminate within their due diligence period. They have until 5 p.m. on the agreed upon due diligence date. Time is of the essence. They have to 5 p.m. on that date to terminate for no reason or any reason. If they terminate after 5 o'clock at 5:01, now the buyer's in breach and they're not going to get their earnest money back. So physical inspection, I got a question about the final walkthrough. Walkthrough is part of the physical inspection. Before we get to the walkthrough though, I think it's important that the buyer see the home several different times during their due diligence process. So we saw it when we first found the home and decided we wanted to write an offer on it. Now that we're under contract, I think it's important that the buyers see it a few more times. I always encourage my buyers to come with me to meet the home inspection at the end, the home inspector at the end, so they can give us their reports. Some buyers want to, take their measuring tape in and see where the couch is going to fit. Some buyers want to take in paint samples. Some want to show off to mom and dad. I think it's important that we get them in the home several times during their contract to close, their due diligence, to put their eyes on it. Guys, the first time they see it, they have rose-colored glasses on. And each time they see it, those glasses come off a little bit more and a little bit more. When you and I are walking in the door with buyers, we need to be looking at something totally different than they are. When we first see the property, buyers are trying to see how this space will fit their family dynamics. So they're seeing, can I see my family doing Sunday brunch here? Can I see us doing Friday night family game night here? That's what they're looking at. You and I need to be helping them see other things. Water stains on the ceiling, crack in the foundation. I'm not a structural engineer. I'm not a roofer. I'm not a general contractor. I do not know why that crack is on the wall. I don't. I have no idea. Maybe it's settling. Maybe it's a structural issue. But by having the conversation with the buyer and encourage them to have that checked out, if they're concerned, or if it's a concern of the home inspector, is part of the physical inspection of the property. Another conversation you guys need to have with your buyers. Make sure they know that they are not to go to that house without you. If they want to see that property, you need to be with them. Guys, they cannot just show up and look in the window unannounced. Trespassing. Make sure your buyer knows that it's not their home yet. This is the voice of experience speaking. Make sure you have that conversation. You need to be with them every time you go, even though they're under contract. Another piece about the physical inspection is the final walkthrough. We need to do the final walkthrough with our buyer as close to settlement as we possibly can, especially if nobody has ever seen that home vacant. If the sellers move out days before settlement, we need to see it vacant. So the question that's come in, a very common question, what if? What if we're doing the final walkthrough and you've never seen it vacant? And you now know the whole reason there's pictures on the walls is to hide holes in the wall, or they ripped the carpet up, or they left a bunch of trash or debris. What if, what if, what if? If the buyer is not satisfied with the condition of the property in the final walkthrough, they have two choices. They either go on to settlement and sign and agree to take this property in its current condition, or they don't. This may be a reason why we have to delay settlement, get on the phone with the listing agent, say this is fixed, this is broke, there's a hole in the wall, we need your seller to repair it. We might be entering into round 3 of negotiations. But as the buyer's agent, it's important that they understand that once they sign at the attorney's office, they're accepting that property in the condition that it's in. How can they sign if they don't see that condition? So the final walkthrough is probably the most important physical inspection that we do. I always do mine on the way to the attorney's office. I've had a few occasions where my buyers couldn't or didn't want to come. So I went through and I videoed it and I took pictures. I documented the final walkthrough. So if the buyer comes in after closing and says, this hole wasn't here, oh, you know what? I got documentation saying it was. You guys with me? Do that to protect yourself. Obviously, we want the buyers there, if at all possible. Do I ever get asked about the size of the framework? I know older houses were built better than now. I would agree with that. I've never been asked about the size of the framework. We're going to do some basic residential house construction. That's unit 16. So we'll go over some very basics of building. You guys, please remember to stay in your lane. If you're not a builder, if you're not familiar with architect, don't just start answering questions for the sake of answering questions. If you do get asked about the framework, don't guess. Questions so far? Obviously, this list isn't inclusive, which means the buyer's free to inspect or investigate anything that they want. Do they have concerns about radon? Was it built prior to 1978? Do they want to have the presence of lead detected? Is there asbestos in the home, mold, well water? Are the streets public or private? We talked about streets back in unit 6. Everything we're looking at, again, this list is not inclusive. Y'all remember my very simple philosophy when working with buyers? If it's important to my buyer, then it's important to me. So if they say, I want to inspect this or investigate that, our answer is, okie doke, let's do it. If it's important to them, that's why they hired us, is to help them get these answers. I've heard of some buyers, I've not had it, but I've heard of a couple agents over the years that have had buyers during due diligence. They want to take the priest to the home to talk about the vibes of the property. Does the buyer have the right to take the priest? If it's important to them, then it's important to me. Schedule a time where the buyers and the priest and you can go out there. Any questions about the buyer's piece of the due diligence process? That's right. That's what we're trying to avoid, right? Bad vibes, we'll call them. And they're out there, you guys. my goodness, I've walked in homes before. Y'all know those teeny tiny hairs on the back of your neck that you didn't know exist? Yeah, there's homes I've walked in the front door. Those teeny tiny hairs. Whew. I don't know what's going on in that house, but whoo, something made those teeny tiny hairs stand straight up. Sage. There you go. The Watcher on Netflix. I need to check that one out. Questions on the buyer's due diligence process. And it's a true story. Yeah, I need to check that one out. So what does the seller worry about while we're under contract? Well, the seller doesn't have anything things to worry about. The contract to closing process for the seller, their number one concern is, can we get loan approval? Can the buyer afford to buy this home? We want to keep the seller informed, the listing agent informed. Everybody know we're on the same page for closing day. And the other big piece, once we know the buyer can afford to buy, the other big piece is helping the helping the seller verify their closing numbers are right, their settlement statement. We're going to talk a little bit about sellers when we do this math at the end of this unit. Again, both of your exams want to know how much your buyer has to bring to closing. We do at the end of this unit what I refer to as a mini closing disclosure or mini settlement statement, because we're only figuring one side. We're only figuring the buyer side. When you guys get to post licensing, we're going to do a full-blown settlement statement. So we get to figure out both sides. That give you something to look forward to? Oh boy, we'll do a full-blown settlement statement. So let's talk about what we're saying. Remember, we talked about working with sellers and all the work that goes in, all the research, the getting ready, the pictures, the measurements, everything that goes into listing the property. Listing agents, when you're working with sellers, your responsibility, I don't want to say your responsibility, but the big part of your job is to get the property ready to list before anybody ever sees it online. Buyer's agents, the big part of your job comes in once we have a contract. So you need to ask yourself what hat you're wearing. Are you working with a buyer or seller or both and getting both of them through that transaction? Questions on either party's due diligence? Communication's key. I can't. Isn't that true for lots of things though? Let's talk about some of the paperwork that the parties have. I didn't reproduce these here. The seller's forms are at the bottom of page 524. The seller's biggest document that they need to be prepared to bring to closing is their deed. Usually, like we said, the buyer's agents. In a typical residential transaction, the buyer's agent will prepare the deed, but they need to have a deed for the information to prepare a new one. If the attorney doesn't ask the seller for the deed, then they're finding it on their own. But if they ask, the seller should provide it. If we do an outside bill of sale for any agreed on personal property, it's not going to be in the contract. For example, I can't tell you how many times I've been showing property and there's been like a Porsche in the garage. And the buyer always likes to say, does the Porsche come with the house? You know what my answer always is? Anything's negotiable. Money talks, right? So you want the Porsche in the garage? How much are you willing to pay for it? If they do an outside bill of sale for any personal property, then the buyer's probably going to bring like a cashier's check or something. Again, we're not going to run that through the contract. If the property has an existing lease or an existing tenant in place, the seller needs to provide the lease documents. any current information on the tenant, where the security deposit is. I got a whole unit dedicated to the tenant and the landlord. So that's unit 11. Seller needs to provide loan balance payoffs. Sellers will have to pay off all of their loans, liens, mortgages on the day of settlement. They'll calculate interest to the day of settlement. So the seller needs to provide their lending information so we can get that paid off. The attorney can get that paid off. And then generally the attorney on behalf of the title insurance company has the seller sign something saying that they haven't had any work or labor done in the home within the last 120 days. Y'all remember that mechanics lien? So we want to make sure anything that the seller has had done has been paid. So we don't have to worry about having a mechanics lien filed on the property after the new owner owns, after the new owner buys. Buyer's documents are at the top of page 525. You guys bought a house in the last 12, 15 years. Did you go to the attorney's office and have a stack of paperwork about yay thick plopped in front of you? A big part of that, I'm not exaggerating if you haven't, by the way, a big part of that is the loan package. The lender sends the closing attorney their loan package. The lender tells the attorney how they want their loan package handled. Remember, the attorney represents both the buyer and the lender. And since the lender isn't there most times, the settlement agent handles that on behalf of the buyer. After settlement, when we all leave the attorney's office, the attorney and the lender, making sure they have everything, is part of the attorney's closing process. So once the buyer comes in and signs, stack of paperwork this thick, I always tell my buyers to get their signing hand warmed up. So they come in and sign everything. And then the attorney sends the loan package back to the lender for final approval. And the lender is going to make sure they have all their signatures, all the I's are dotted and the T's are crossed. Once the lender is satisfied with the completion of the loan package, then they release the funds, then they release the loan amount. And that's usually the last piece the attorney needs before they can record that new deed. Buyers will get a new title insurance policy. Remember title insurance back in Unit 5, protecting buyers from errors of the past. So anything that they can, now that they're the owner, if anything comes up that affects the title that could not have been discovered by a search, title insurance policy is there. Title insurance will not issue the new policy without the opinion of the attorney first. So again, that's part of what the attorney does, known as closing, putting the finishing touches on everything. If it's a VA loan, they're not going to need a copy of the wood destroying insect report, the pest inspection required for all VA properties. And then if there's a survey, like we said, not required by all lenders, but if the lender has a little red flag go up, they may request the buyer to get a survey. Again, this list isn't inclusive. Whatever we need to get it to close, this just kind of gives us an idea. There's a lot of paperwork involved in closing, especially now. Questions? Talking about title procedures on 525, again, this goes with the discussion we had about the title back in Unit 5, kind of the attorney's role, the attorney's responsibility. Once we go under contract, the attorney will do a preliminary title search. This is the big, thorough, in-depth one. If they find any issues, if they find any problems with the title, the attorney will get with the seller to clear those up. Remember, you guys, the buyer is the attorney's client. The attorney's biggest responsibility to their client is to make sure they're receiving clear marketable title. So if they find any issues, if they find any kinks in the chain, the attorney will work with the seller to get that cleared up. Generally, the attorney will issue one, they'll do one more quick title search. That period of time between settlement and closing. They'll do one more quick search, and then the attorney will offer their opinion of title. That's what they provide to the title insurance company. That's when the title insurance company will release title insurance for the new owner. It covers the new owner for errors of the past. But they're not going to get that policy until we have that final opinion from the attorney. They do. So then we get that policy, protects the new owner. And again, part of the title insurance company is going to be this affidavit from the seller saying, I promise nothing can come on later and affect the title. If something does show up after closing, the title insurance company is almost always going to go after the former seller first because they signed something saying this wasn't going to happen. So title insurance will almost always go after the seller. And if the seller's dead or broke or MIA, then title insurance will take care of it for the new owner. Today they're the buyer, tomorrow they're the owner. Questions? $526, we're getting closer and closer to closing. Conducting the closing. North Carolina is a, well, we're not. It's known as an escrow closing. We're going to talk about what we are in just a second. Other states, and I don't know particularly which state, but other states may use an escrow closing method. The parties don't attend closing. An attorney doesn't conduct closing. Usually in escrow closing states, it's somebody from the title insurance company that's handling the closing transaction. So the parties don't have to attend, they just send their stuff in to whomever's conducting the closing, the escrow agent. And these other states use something called the relation back doctrine that said the deed is considered delivered when it's prepared, when it's delivered to the escrow agent. So once the escrow agent gets it, the deed, in a sense, becomes the buyer's. Why is it important that we talk about this, you ask, if this is not how we do it in North Carolina? Well, North Carolina is one of few states that doesn't use the escrow closing method. This is more common than our system that we're talking about next. So it's important, one, that we know there are two different ways to do it. North Carolina doesn't use escrow closing. Because if you're ever working with a buyer that's moving in from another state, at some point they very well may ask you, do I have to hire an attorney? And your answer is, if you're buying a house in the state of North Carolina, yes. Because North Carolina is a settlement meeting method state, which means in North Carolina, we use a settlement agent. We use a closing attorney to process it. The attorney is the one that, again, does the title search, handles the recordings of the deed of trust, finalizing everything. They communicate with the lender. They communicate with the title insurance company. They communicate with everybody. Most sellers in North Carolina will have to report the sale of the property to the IRS I don't know if you're subject to taxation or not. You need to talk to your accountant. But the attorney generally sends the form in on behalf of the seller, so they don't forget. So the attorney will do that for the seller. And then the lender has an interest as well. The lender's interest is to get paid. One thing the lender does to protect their interest, as soon as the attorney is done recording the new deed, the very next breath, they're going to record the lender's deed of trust. You don't even have keys in your hand sometimes, and you already have a brand new lien put on your property. That's what the lender's interest is. Making sure that their deed of trust gets recorded immediately after the deed. Why? In the event of foreclosure, we want, remember, lien priority. They want to make sure they're first in line. So the attorney will do that on behalf of the lender. As far as who typically attends settlement, you almost always need the buyers there. There may be an exception. The lender and the attorney may allow for a mail away closing in extreme circumstances. It's up to the discretion of the attorney and the lender. But for the most part, we have the buyers there. Buyer's agents, you need to go with your buyers to settlement. You've been with them since day one. You need to see this through. If you guys have bought a house, it's a nerve-wracking experience, isn't it? And I'll tell you, it was the first time, let's see, I bought my first place in 2006. And as a first-time home buyer, I was nervous. I mean, I got out of the car at the attorney's office and I swear my knees were jello. I thought, oh my goodness, what am I getting ready to do? 30-year commitment. And I looked up in the parking lot and here comes my agent. Yoo-hoo, you ready to do this? It was a reassuring face. It was comforting. It was good to have her there, help walk me through this. Can I answer that in just a second? Questions on the closing, particularly the closing. Excuse me. So let's start talking about some of our RESPA and TRID again a little bit. Again, we didn't get TRID until October 2015. TRID just turned, what do we figure, 7 years old. Happy birthday, TRID. Please understand, TILA's always been around, RESPA's always been around. TRID is what's new. And what TRID did was integrated the two, it combined the two. So for example, on page 528, we used to have a good faith estimate. That's that GFE, good faith estimate. Excuse me. And we used to have an early truth in lending, TIL, early truth in lending. One was a RESPA form, one was a TILA form. And consumers are like, aren't I signing the same thing twice? They look awfully the same, very similar. So what TRID did was combine those two forms. And today we have something called the loan estimate. It eliminated duplicate content. When we went to closing, one used the HUD-1 form, the other one used the final truth in lending. Again, duplicate content, duplicate information. TRID said, let's combine them. And today we have the closing disclosure. We'll talk a little bit more about both. Here's our introduction to RESPA, Real Estate Settlement Procedures Act. RESPA is the R in TRID. So TILA is the T in TRID, Truth in Lending Act. Regulation Z, RESPA is also known as Regulation X. I would know that RESPA is also known as Regulation X. So we got Regulation Z for TILA, Regulation X for RESPA. Again, everything about TRID today is to protect the consumer. It's important that we understand in this transaction, the consumer that TRID is protecting is the buyer, because they are the ones originating a new loan. TRID is not out to protect the seller. TRID is out to protect the buyer in this transaction and help educate them throughout the transaction, throughout getting that loan and that process. RESPA applies to all mortgage loans, federally related. This includes conventional, FHA, VA, USDA, all the loan types that we talked about the other day. RESPA applies to 1 to 4 family dwellings. So if you're buying a unit with 5 dwellings or more, TRID is not around. I also think it's important that we remember TRID is a lender law. So if it's a cash buyer, the rule for cash buyers is there are no rules. There is nothing in force. TRID is a lender law to protect the consumer. Again, the consumer in this transaction is the buyer. And making sure the consumer, the buyer, understands their cost to get the loan, TILA, the cost to close, RESPA. It's not just a matter of throwing them numbers and saying, here you go, sign here. It's helping them understand this commitment. It's helping them understand the terms. Questions so far? So let's take, I'm going to answer your question in chat right now. Let's take our last break. Let's take 10. Come back, we'll knock it out for the day. How we doing? What questions do I have so far? Anything? I like Unit 21. Some of it's kind of a recap of things that we've talked about, isn't it? So some of it's kind of a nice little refresher. And if I say something about remembering Unit 5 and you don't remember in Unit 5, then this week you may want to go back and refresh Unit 5. Again, I cannot stress the importance of you guys using this next week to your advantage. We will talk about what I would like you guys to do to get us ready for next week when we come back together. So that's where we'll end it. So I like the way some of you think. One of you said almost lunchtime in Savannah. As a matter of fact, I was thinking the same thing. So we're getting hungry, aren't we? All right, so let me take attendance. I'm 2 laptoping it today, by the way. I miss yeah, you guys know I have 2 monitors plus my laptop. So I actually use 3 monitors to teach class. And today I already have 2, only have 2. So I'm winging it a little bit. All right. Yeah, I can't wait to go check out Savannah. But before I do that, we need to talk a little bit more about RESPA. Boy, do I know how to have fun. So RESPA is the R in TRID. RESPA, it's a consumer protection. And one of the best ways we can protect the consumer is to disclose and educate. And that's what TRID is all about. Protecting the consumer, helping them learn about their loan product. So look with me, if you will, page 530. Thank you for telling me you're back. This is what we were talking about when we first started class today. When we were talking about the loan application. The loan application is considered received when the lender receives three pieces of information about the person or people and 3 pieces of information about the property. So these 6 pieces, the first 3 are about the person, the last 3 are about the property. And these are the pieces, once the lender has these 6 pieces, that's when they've considered that they have the complete loan application. And that's when their big work, their big process can start. So the first 3 pieces are about the person, which again, this takes us back to our conversation earlier. The lender can only go so far in the loan application process until we have a property, until we have a contract. Does that make sense? So we could get the information about the people and start that piece of it. But until we have a contract and we have a property address, estimate, property value, and the amount of the loan, that's when the lender truly starts their loan application, their process for this particular property. RESPA, once again, is a lender law, which means the lenders have to follow certain rules and TRID, and TILA, RESPA. It's all a lender law. And some of the regulations that RESPA puts on the lender today, within 3 days of loan application, within 3 days of receiving those 6 pieces of information, RESPA requires the lender to provide the borrower with a know before you owe booklet. It's a booklet that educates them on the purchasing process, encourages them to shop around for various inspectors, investigators, etc. Also, within 3 days of the loan application, RESPA requires the lender to produce to the borrower a loan estimate. Did you guys hear what I just said? Within 3 days of loan application, the borrower has a loan estimate. I'm pretty fortunate, you guys. My husband and I bought our house 2 years ago, and I got to go through it as a buyer getting a loan. And it was really a good experience for me to see that end of it, that piece of it. My Know Before You Owe booklet, my loan estimate came in the form of a software program that my lender has that they use to communicate with me. So you guys know how sometimes your doctor sends you messages and it tells you an email, it sends you an email telling you that something's been uploaded to your file? That's kind of the way the lenders work. They don't actually mail you the Know Before You Owe. They put it in their little software program, and then send you the message to log in and check it out. And then they can see that you viewed it. They may ask you to sign off on it. So if it ever comes up, if they're in the RESPA requirements, they have documentation of you doing that. So let's look, turn with me, if you will, to page 535. 535. And what we're looking at on 535 is our sample loan estimate. Now, this is just a sample to give us an idea, but you can see there's the applicant information, there's the property, the sales price, and then we have the loan information. So term, it's for a purchase, fixed rate, conventional. Under that, you have the loan terms. What's the loan amount? What's your projected interest rate? What's your projected monthly and principal and interest? Is there a prepayment penalty? Yes or no? Will there be a balloon payment at the end? Yes or no? Then we have our projected payments. Guys, we just wanted a contract like 3 days ago. I don't know yet what my insurance is going to be. Maybe we know taxes, maybe we don't. This is why this is an estimate. But within 3 days, we can give the borrower an estimate of what we think their monthly PIPI is going to be. Y'all, I can't tell you how huge this was. This is new post housing market crash. If you ever bought a home before the housing market crash, you very well didn't know your payments, your numbers, until you got to the settlement agent. Can you imagine they're sitting there signing away all your loan application and not knowing what your monthly payment's going to be? That's scary, isn't it? You're signing something and you don't know what you're signing up for. Thank you, TRID, for stepping in and saying, we need to educate the consumer. And this is what that's about. They know within 3 days of loan application that their estimated monthly payment is going to be $1,050. That's huge. Come down a little bit more, estimated closing costs, estimated cash to close. Flip over to page 536. Again, just as a sample to give us an idea, this is a breakdown of how we got that estimated cash to close. So we don't just say, when you come to closing, you got to bring $16,000, $16,054. That's one thing to say that, but this actually goes a step further and it explains how they get to that amount. Does that make sense? This is huge. So if they have a question about the loan costs or any of the escrow amounts, they can ask well before they close. And this is what we're doing. We're educating the consumer. More information about the loan on page 537. Again, just to give us an idea of this loan estimate. So everybody have that written down, 3 days of loan application. Once the lender collects those 6 pieces of information, their clock starts. This is an estimate. This is not a final. Can estimates change? Can things change? Absolutely. So it's important that we understand that this is just an estimate. This is not final numbers yet. But RESPA has also offered some tolerance limits on what can and cannot change. So just because this is an estimate doesn't mean the lender can just throw us numbers. They need to be accurate numbers. They need to be good numbers. And RESPA says, okay, there's some tolerance limits to things that can change from the estimate to the final. One thing that's not allowed to change from the estimate are the lender's fees. Whatever the lender tells the borrower they're going to collect in fees at closing is what it is. It cannot change. You guys remember the other day we introduced you to the loan origination fee? And we said that's a percentage of the purchase price. So if the purchase price changes, that amount's going to change. But what can't change is the percentage that was quoted. Does that make sense? So if I tell you 1% of the loan, if that changes, it's still 1% of the loan. RESPA allows a 10% tolerance up or down, things that can adjust. These are usually settlement services that the borrower cannot shop for. An example of a settlement service that the borrower cannot shop for is the appraiser. The lender orders the appraisal. Remember, it's their property. Appraisers from the lenders should be like in a big pool. And when the lender needs an appraisal, they order the next available appraiser, and that's who goes out. In other words, lenders don't have preferred appraisers that they use over and over and over again. It helps keep it fair for all parties. Let's say I was buying your house and I had my appraisal done and it was way off from our asking price. And you find out that the appraiser was actually my Uncle Bob. Do you have a concern? Do you feel like Uncle Bob might have favored me a little bit? So the appraiser needs to be neutral. The appraiser needs to be fair. And that's why there's not one that the lender uses. Usually, like I said, they're in a big pool. And when the lender orders an appraisal, they don't necessarily know who's going out until it's been ordered. That's an example of a 10% tolerance. Then there are other fees that can and do change. These are things out of the lender's control. The buyer gets to pick their home inspector. The buyer gets to pick their pest inspector, their surveyor, all that, radon, all of that. The lender can give us an estimate for the cost of the home inspection, but they have no idea until we order it. That generally happens after this loan estimate. So it's so important that you guys hear me say this is a loan estimate. Here's the deal. It's never a problem when these numbers go down. The problem is when the numbers go up. That's one thing that the loan estimate can't do. The lender needs to make sure that they get in as close as they can. The problem comes when the numbers go up, and we'll see that in just a second at our closing disclosure. Do you have any questions so far? The loan estimate, what is and is not allowed to change? Okay. Thank you. So we went under contract within 3 days of loan application. We got the loan estimate. Now let's fast forward to closing. Were you ready to go to settlement? RESPA also has some documents that they require the lender to send the borrower closer to closing. RESPA now offers 2 closing disclosures. It used to be everybody's numbers was all together. Remember, the consumer that we're protecting in this transaction is the buyer. TRID doesn't think it's fair for the seller to see the buyer's numbers. So TRID now requires 2 closing disclosures. One closing disclosure is for the seller. The attorney prepares that. The lender, the buyer's lender, has nothing to do with the seller. I think that's worth me saying again. The buyer's lender has nothing to do with the seller. The attorney will prepare a closing disclosure for the seller. It'll help the seller see how much they're hopefully going to get from closing once this transaction happens. This is usually a couple days before settlement. Listing agents, we need to have the knowledge to help our sellers verify that these numbers are right. Do y'all think the seller knows how to look at these things? No. That's why they hire us. So listing agents, you'll get your seller CD a couple days before settlement. So you can help them verify that number. This is the math that we're heading to at the end of this unit that we'll see. I think it's November 2nd. Does that sound, whenever we meet again, let's just leave it at that. Don't let me say a date. Whenever I see you guys again. The other closing disclosure then is for the borrower. This is the one that TRID is involved in. And TRID has some rules with how we get this closing disclosure to the borrower. TRID says if the lender can guarantee personal delivery, thank you. If the lender can guarantee personal delivery, the borrower has to receive the closing disclosure 3 days prior to settlement. When we're talking about closing disclosure, borrower closing disclosure, days do not include Sundays. They do not include national holidays. When we get this, or I should say, when your borrower gets this from the lender, we are very close to settlement. We've gotten the clear to close. They've crunched those final numbers. The point of this is not to rush anybody. We saw the estimate, we signed off on the estimate, but now that we have the final end all be all in the closing disclosure, TRID says you need to allow these buyers 3 days, business days, to look at these numbers, make sure they're good, and see if they don't have any questions. When counting days, you always count day 1 as the day after receipt. So if your buyer receives their closing disclosure today, day 1 is Friday, day 2 is Saturday, skip Sunday, and day 3 is Monday. If your buyer receives their closing disclosure today, there is no possible way we can close before Monday. We have to allow 3 days in between receipt and settlement. Mark my words. You will have a closing delay because of this rule. There's nothing we can do about it. There's nothing the lender can do about it. There's nothing that the attorney can do about it. Remember, we said delays in closing just happen. And what's one reason that could delay it? Because the borrower has not received their closing disclosure yet. The 3-day rule applies if it's personal delivery. So if the lender actually hands it to the borrower, or if they use that software I was just mentioning, and the borrower signs receipt, the lender can verify they show that the borrower logged on and looked at it and signed. If it's not personal delivery, then we have to allow 6 days between delivery and settlement. If y'all want some good news, I've never had to wait 6. All lenders I've ever worked with have had the ability to prove that it was received. So that's right. As this says, Sundays don't count, national holidays. So if Monday is, I don't care, Christmas, you receive it today, Friday would be day 1, Saturday would be day 2. We're not going to count Monday. We're not going to count Sunday or Monday. So now Tuesday would be the earliest we can close. We can close on day 3. And we start counting days the day after receipt. Again, things that we can do to prepare our buyer for this. This is 100% out of everybody's control. The delivery of the closing disclosure is directly from the lender to the borrower. This is one form of communication that you and I cannot get involved in. We can't say, well, I'll forward it to the borrower. No, this is directly between the lender and the borrower. Once the borrower signs that they received their closing disclosure and it starts our 3-day count, the lender and the attorney will usually put the finishing touches on things. And once they finalize it, that's when you and I get to see it. so we can review it for accuracy. Again, you guys, we are days away from settlement at this point. We've gotten the clear to close. The borrowers received their closing disclosure. And now you and I are send it so we can review it for accuracy. Once again, that's the math that we're going to do when we come back together on the 1st. Thank you for looking at your calendar for me. It's hard to believe the next time I see you guys is going to be November. Dang, where does time go? As with the, well, actually, before we do that, let's look page 540. Page 540. .540 is our sample closing disclosure. This is the sample closing disclosure from the sample loan estimate that we received 3 days after loan application back on 5/35. So we should be able to compare and contrast the two. So 540, again, we're reminded of the closing information, the borrower contract. My loan amount is still 162. My interest rate is still 3.875. That information has not changed. Scroll down to the bottom of page 540. Remember when we went under contract, the loan estimate said that your buyer had to bring $16,054. That was the estimate. Now at the bottom of page 40, what's their cash to close? Now they only have to bring $14,147.26. Isn't that good news to the buyer? We told you 16,000 something. Now that we're here, you only have to bring 14,000 something. That's what we mean by it's okay for those numbers to come down. That's good news for the buyer. If cash to close was more than that 16,000 number, now the lender's got an issue. It's been my experience that lenders tend to over exaggerate costs just so they can produce that good news to the buyer that, hey, you don't have to bring as much as what we thought. And it keeps them in compliance as well. Again, 541 and 542 is the closing disclosure, page 1 and page 2, 541, 542. 541 kind of gives us a breakdown of various debits, various expenses. 542, again, we'd usually see 2, but I think to reduce paper, they kind of lumped it all together. The buyer's information's on the left, the seller's information's on the right. Very bottom of 542 tells us how much our buyer has to bring to closing. There's that 14,000. It also tells us how much our seller can expect to get. What I like the most about the closing disclosure through assisting my buyer is the top of page 542. There is an actual side-by-side comparison. These are the numbers you were told with the loan estimate compared to where we are now at the closing disclosure. You guys see that, page 542? To me, that's the most helpful piece of this whole thing for the buyer, because they can say, see exactly, I mean, even did this change, yes or no?
Did we lose Julie? Good deal. I'm just making sure it wasn't my computer only.
She's having a problem with her hotel internet, apparently.
All right, well, good deal.
You guys there? No,
Hey,
I want to
yes.
disappear.
All right.
All right, thank you. Can you guys see me? We good?
Yes.
All right, good, good, good. I'm usually in mid-sentence, by the way, when I disappear. So what was the last thing you guys heard? We were still talking about our, were we still talking about our closing disclosure and what we're gonna do in post licensing, 541 and 542? Is that where we were? So, yes, ma'am, Ashton has a question.
So even though when we're looking at the top of 542, the total closing costs did end up going up because the overall cash to close wasn't more, it doesn't matter.
Exactly, exactly. So it's kind of how those numbers shake out in the end. So it tells us, did this change? And it says yes, and then it tells us why. So what change was the loan costs and other closing costs? Again, and that's where that tolerance can come from the loan estimate. The things that
Gotcha.
can change. Yep. Like I said, in practice, in the real world, the lenders, most lenders I know kind of overestimate those amounts. They may say, I mean, a typical home inspection, it depends on the size of the home, the age of the home. There's so many variables that go into how much a home inspection costs. Each home inspector charges differently. So that's why we kind of have that wiggle room. Good question. Thank you. As with the loan estimate, let's see, I got some, let's see. Okay. As with the loan estimate, there may be some changes from the time the borrower receives their closing disclosure and settlement. Changes just happen. So the allowable changes for the closing disclosure. If the APR increases, if a prepayment penalty is added, or if the basic loan product changes, that's going to require the lender to issue another closing disclosure, and that's going to require a new 3-day count. These are the only things that will require a new 3-day count. You can have other changes, but they're not going to require a new 3-day count. So if the APR goes up, you add a prepayment penalty, or the buyer changes the product. If, for example, and I can't imagine this happen. I mean, this makes my heart flutter a little bit just thinking about it, but evidently it's a thing because we got a rule on it. But if the borrower decides the day before closing, they don't want a conventional loan, they want to go to FHA, that would be a loan product change. We'd have to issue a new closing disclosure, or the lender would have to issue a new closing disclosure, and we got to do our new 3-day count. Again, any other change will not require the new 3-day count. You and I are going to help the buyer verify the accuracy of the numbers that we can. I'm not responsible for every single number. I can only help the buyer verify, help them crunch their numbers. And again, that's where we're going to head on the 1st, next Tuesday. So what's all this mean for us? Let's bring this in for us. Well, as we said, we have a duty to help our consumer verify the accuracy of the information that we should reasonably know. Let me ask you guys a question. Hang on, I know. There you go. If once you get the closing disclosure to review for accuracy, information, examples of stuff that I can help them verify would be things like the sales price, the amount of the due diligence, the amount of the earnest money deposit, any seller paid closing costs. for example. Who can tell us, where am I getting that? Where do I get that information so I can verify it? How do I know what the right sales price is? How do I know what the right due diligence, the right earnest money? How do I know? I want to stab a venture a guess where I can verify that information is correct. Here we go.
The contract.
Yeah, yeah. Agents, once you get these closing disclosures to review, the first thing you need to do is go back and pull out the contract. Were there any amendments to the contract? Do we amend the purchase price? Do we add due diligence? Do we add earnest money, for example? I don't know about you guys, but in some cases, we went under contract 6, 4, 8 weeks ago. My little brain doesn't remember all those numbers from 6 weeks ago. So when I get the closing disclosure to review, I automatically pull up my contract. That's an example of information that I should reasonably know. Isn't it reasonable that I know the purchase price? I mean, I'm probably the one that wrote it up anyway, right? I think a good example of information that I may not know, I probably was not privy to the conversation between the lender and the buyer. I wasn't part of that phone call. I do not know how much the lender told the buyer they were going to charge them. That may not be information that I can verify. I need to look out for my red flag though, right? Once you guys get in it, you're going to start seeing these charges are similar, usually 1 to 3 to 4%, something like that. So if you see the lender's charging 15%, I would have a flag go up, be on the phone with somebody. So even though I can't verify the accuracy of it, I can be familiar with what's common. Here's the deal. When you find a mistake on these closing disclosures, we've got to report them. We've got to notify the lender. We got to notify the attorney. Did you hear me say when and not if? Humans prepare these things. Humans make mistakes. The thinking here is that the more sets of eyes we have on it, the better chance for accuracy we're going to have. And when you find a mistake, we've got to report it. We must report it. Just call the lender and or the paralegal. You do not have to be nasty about it. Just call them up and say, this purchase price isn't right. Guys, I've seen earnest money wrong. I've seen additional earnest money not being added. I've seen home inspection receipt not being added. I reviewed a seller closing disclosure once. I was the listing agent, and I reviewed the seller closing disclosure, and they forgot to put our commission on there. Could you imagine what would have happened if I didn't review that? I don't know either, but oh, the horror, right? So I called the paralegal, and I said the buyer's agent was Mike. And I said, Mike and I really want to get paid. And you know what she said? She said, oopsie, oopsie, oopsie. Guys, we need to be reviewing these things. If you're working for the seller, or if you're working for the buyer, and do what we can. And that's why we're going into the math that we're going into at the end of this unit. What questions do I have? Couple other things that RESPA does to protect the consumer. You guys there? Are you there? Okay, okay. Thank you. Couple other things that the RESPA does to protect the consumer, starting on page 551. We're not going to get into too much detail on these now. You guys will spend more time in RESPA when you come to post licensing. So we're just kind of introducing you to some of these ideas, some of these topics. RESPA, if there's a controlled business arrangement, RESPA requires the the business is going to benefit, to disclose what that is. So for example, we're starting to see this idea of a one-stop shop. So what I mean by that is under one roof, you may have a real estate agent, a lender, and an attorney. We share space, we share an office, and we work together in this controlled business arrangement. And it might be that somebody benefits, maybe my real estate firm benefits from you using my preferred vendors, my preferred attorney and lender. And if that's the case, that needs to be disclosed. If I'm going to benefit from you using these parties, it needs to be disclosed. Do your head. Do my buyers have to use my preferred lender? Do they have to use my preferred attorney? Absolutely not. We put it out there as an option. And if they choose to use that attorney and that lender, we have to disclose what that arrangement is. What kind of, I guess for lack of a better word, kickback we're going to receive as part of that arrangement. So it's about disclosure. RESPA requires a borrower credit for yield spread premium. The yield spread premium, if there's a mortgage broker involved, a mortgage broker is meant to connect the lender and the borrower. So it's kind of a third party that's working together to bring the two together. And if there's a mortgage broker involved, they may expect to get paid. And in the past, one way they got paid was by increasing the lender's yield. Remember, a higher yield makes for a more sellable loan. Today, RESPA says, if you're going to charge the borrower for that yield spread premium, if you're going to charge the borrower for that mortgage broker, we need to give them a credit back at closing. The borrower should not have to pay that. So it's protecting the consumer from paying unnecessary fees. RESPA puts restrictions on escrow account. So we talked about your taxes and insurance. Every month, you pay a 1/12 of your annual taxes and a 1/12 of your annual insurance. And as they collect that 1/12 each month, it goes into an escrow account. You as a borrower have your very own escrow account. So they hold that money. And at the end of the year, when taxes and insurance are due, they use that money from the escrow account to pay those bills on your behalf. RESPA has put restrictions, they've put regulations on how much the lender can collect for escrow. Today, it's only a 1/12 of annual taxes and a 1/12 of annual insurance. As taxes and insurance go up, so could your mortgage payment next year. Remember, your principal and interest stays the same for the life of the loan. And my homeowners on the call know that if your insurance goes up, it's because your taxes and insurance, or not your insurance, I'm sorry, your mortgage payment goes up. It's because of your taxes and insurance. We'll talk more about this escrow account. We got to originate this as part of our buyer's closing costs. So we'll talk more about that next week. Loan servicing disclosure. Remember, if the lender is servicing your loan, they're selling it. RESPA requires the lender to inform the consumer if your loan can be serviced, if it can be sold. And the second piece of this is when the loan is sold, both parties have to notify the borrower. So you'll get a letter that says, from one lender that says, we've sold your loan. You'll get a letter from another lender that says, we have serviced your loan. We have purchased your loan. That's because RESPA puts requirements on that. And then this last one is the one that affected us personally. RESPA says settlement service providers can no longer give or receive referral fees or kickbacks for recommending other settlement service providers. Guys, you and I are settlement service provider. I cannot give or receive a kickback or referral fee for recommending services. Life used to be good. Home inspectors used to say, I'll give you a $25 Amazon gift card every time you send me a client. Or the lender might say, I'm going to put your name in a hat. And at the end of the year, I'm going to do a drawing for an all expenses paid cruise. Life was nice. RESPA did away with that for us. Let's think this through. If I know I'm going to get something, if I know I'm going to get a referral fee or a kickback, am I necessarily having my buyer's best interest? Maybe this lender doesn't do a good job, but you know what? It gets my name in the hat for a cruise. So who am I going to send my buyer to? I want to go on that cruise at the end of the year. They did away with this to help keep us from pushing our buyers to using certain lenders, any settlement service provider, anybody involved on our working years. They can receive a fee if services were actually rendered from that referral. That may be a loophole you have found, but for the most part, anytime you're recommending a settlement service, you can't get a fee for recommending that service. Here's the deal, you guys. Bottom line, I cannot accept $1. I cannot accept a donut for recommending a settlement service provider. Now, this is what's happening because once you guys, I hope you guys like donuts, because if you do, you're coming in the right industry. Everybody will bring us donuts. I thought that was the coolest thing when I first got in real estate was all the donuts. Now I'm kind of like, can't y'all bring me a bagel or something, some cream cheese, something? So you're going to get donuts. And lenders, home inspectors, people are going to come to your office with a box of donuts and a stack of their business cards. They can bring a box of donuts and stack of the business cards and say, we're going to leave these on the kitchen counter. You guys help yourselves. Let me know if I can help. What they can't do is walk in the door with a box of donuts and say, you, and you get a donut because you sent me business last quarter. You guys see the difference? If they're bringing a box of donuts, it's for the whole office. Is it so we use their services? Well, of course, but it's for the whole office. Let's look at a couple examples here. Home inspector pays a real estate broker a $25 referral fee for each buyer the broker refers to the home inspector. That is not allowed anymore. We can no longer give or receive. The home inspector can try to give it to you, but I cannot receive it. I think the other examples are cruise. For each borrower referred by a broker, a mortgage loan officer places a number drawing into a box and gives the broker a stub. At a pre-designated point in time, the ticket is drawn and the winner will win that all expense cruise. Game over. Again, we're never pushing our clients to use a certain lender or a certain home inspector. Y'all remember, this is their product that they're shopping for. So this is why today we give recommendations. Here's a list of 2 or 3 names, 2 or 3 lenders, home inspectors, whatever I've used in the past. That's where we are today. So again, gee, Julie, what's the big deal? Well, violation of RESPA could receive a $10,000 fine per violation. How's that $25 Amazon gift card looking now? How's that donut looking now? Is it worth it? You could be looking up at 1 year of prison. An injunction is a legal stop. If the court or the commission put an injunction on you, you can't work, you can't practice real estate. You may have to compensate the victims, the injured party. And you could face treble damages plus your court costs for both parties. What does treble damages mean? You take the damage and you times it by 3. Again, I ask you, is it worth that donut? Is it worth it? I mean, I'm sure it was a good donut, but is it worth it? We cannot give or receive. questions or comments? Go get your own Krispy Kreme. That's right. It'd be a lot better in the long run if you did that. Absolutely. They're starting to come back out. You know, they kind of disappeared during COVID because I mean, we weren't even in the office, but they're starting to come back out. We had I'll share with you guys, we had who was it? It was a home warranty rep brought us lunch, I don't know, a couple months ago. And they, you know, when they bring you lunch, you got to listen to the little spiel, right? So they bring us lunch, taco bar, always fun. And in the middle of their little spiel, don't y'all know another home warranty rep came in with a box of pastries? Like, oh, this is awkward. Oh, this is awkward. They're starting to come back. And they're bringing us donuts and pastries and taco bars. Would they want us to use their services in their business? But again, if they're bringing us something, it's for the whole entire office, not just you because you sent them business. Questions, comments? Okay. So let's talk about what November 1st is going to look like. We're going to do our settlement statement. The first thing I want to do is give you guys the information in the book on where you can find this math that we're getting ready to do when we get back together. So we're going to talk about the settlement statement starting on page 553. You got those math concepts. We introduced you guys to proration back in Unit 3 when we talked about property taxes. So now that we're here at closing, we're going to learn how to prorate those taxes. When we're prorating something, we're just making it fair between the parties. If you buy my house today, is it fair for you to pay the entire year's property taxes? If you buy my house today, is it fair for me to pay the entire year's property taxes? No, I'm going to pay my fair share. You're going to pay yours. That's what we're going to talk about with proration, how we can make that fair. And then the back of your book has a math facts section. Again, all to get us prepared for next week or November 1st when we do our settlement statement. I want you guys to look with me on page 562. 562. Let's call 562 our formula for doing these settlement statements. This is a great place to start. This is what I want you guys spending time with over the next week. Because we need to know things that are typically debits to the seller, things that are typically credits to the seller, things that are typically debits to the buyer, things that are typically credits to the buyer. A debit just means the party owes that fee. A credit means they have money coming in on their behalf. So let's look at the sellers. We got all the sellers' debits. There's our commission, deed preparation fee, excise tax that we talked about back in Unit 5. So CDE, commission, deed prep, and excise tax. In addition to that, the seller is going to be responsible for paying off their mortgages, their liens, any outstanding debt, delinquent taxes, for example. All of that will show up as a debit to the seller. Typically, always do what the problem tells you. I told you guys that for your exam, you're going to have to figure out how much the buyer has to bring to closing. So why do we care about the seller? Do you think they're going to throw a seller debit in that problem as a distractor to try to trip you up? Everybody adamantly shake your head yes, because you know what they try to do? They try to throw you distractors. So we need to know things that are typical to the seller So we know that's a distractor and it doesn't count. They will put commission in there. And if you don't know, that's typically a charge to the seller. You're gonna put it in and get the problem wrong. Then we have items to the buyer. So the first, several there, their new homeowners policy, loan origination fee, any finance charge, anything to do with the loan. There's our discount points, recording fees to record the deed and the deed of trust. I want everybody to please note, the seller pays to have the deed prepared. The buyer pays to have the deed recorded. Does everybody see that? Seller pays deed preparation. Buyer pays deed recording. When the attorney is getting the deed ready for closing, it's still the seller's deed, which is why they paid to have it prepared. Whose best interest is it that the buyer gets their brand new deed put on record? That's the buyer, which is why they get to pay it. So does everybody see the difference there? Seller pays to have it prepared. Buyer pays to have it recorded. There's their mortgage, that deed of trust. They get to pay to have that recorded on behalf of the lender.
What page is that on again?
I'm on 562. Your homework for the week. Then under the buyers, there's the earnest money. Earnest money is going to be a credit to the buyer. They paid that when we went under contract. And we told them, if you make it to closing, the earnest money will be credited back to you. So now we're at closing. We need to make sure that we credit the buyer. The buyer's loan on the day of settlement is a credit to the buyer. The lender is bringing that money on the buyer's behalf. So on the day of settlement, it's a credit to the buyer. Tomorrow, in the next 30 years, the buyer's going to spend paying the lender back. Everybody with me? That's what they're doing. The lender's bringing money to settlement today. So today, it's a credit. It's on the buyer's behalf. Go back then to page 561. 561. I think this is helpful as well. Items to be prorated. We're going to talk about prorating taxes. We're going to talk about prorating HOA dues. A true proration is a credit to one party and a debit to the other. Who gets the credit and who gets the debit depends on who owes whom. So when we prorate, when we do that, when we come back together, we're going to learn to figure out, is it a debit to the seller and a credit to the buyer, or is it a credit to the seller, debit to the buyer? And then you have double entry items. It's double entry because it's showing up twice on the settlement statement. I think the two you guys need to worry about is the sales price. Credit the seller, debit the buyer. The buyer's paying the seller the sales price. Isn't that the whole gist of our 16-page offer to purchase and contract? So the sales price is going to be a credit to the seller, debit to the buyer. The other one of these I think you guys should worry about is the due diligence fee. We're going to credit the buyer. They've already paid that once, and we told them it would be credited back. But we're also going to debit the seller because they received it when we went under contract. We got to reverse what we did when we went under contract. So if I was buying your house, we went under contract, I'm actually handing you a check. Debit from me, credit to you. Now that we're at settlement, we need to reverse that. And that's what we're doing by this double entry. If you guys will, please, flashcards, jot it down, whatever. Spend some time on page 562, particularly. Those few things we talked about on 561. Knowing what's a debit to whom and what's a credit to whom is a big, big part of determining, of doing these closing statements, these closing disclosures. If you guys can spend some time with this, I promise when we do these on November 1st, it'll go much smoother.
Julie,
Yeah.
is this always prorated by the 30-day month, 360-day year method?
So in pre-licensing world, every month has 30 days. Every year has 300, or yeah, every month has 30 days. Every year has 360. So the good news for you guys is we're going to learn is you don't actually have to memorize how many days are in October, how many days are in February. In pre-licensing world and for your exams, every month will have 30 days. 30 times 12 is 360. So in 30. In pre-licensing world, how many days are in February? 30.
South Carolina does both. It's
Oh,
very
fun.
confusing.
Yeah. And you may see some practice problems that tells you to use the actual days of the month, in which case you have to if you want to get the practice problem right. I'm telling you, for your exams, both mine and state, 30-day month, 360-day year. So we'll talk about what that means. Sales price is debit to the buyer. That's what started this thing to begin with. The buyer promised to pay the seller X amount in exchange for the property. And now here we are. So that's where we're going to leave each other today. So that means as soon as we come together after our little break, we are going to walk in the door with our calculators in our hand. So the first thing we'll do on November 1st is our settlement statement. You guys are welcome to look ahead. I encourage you, please use this time to help get yourself caught up and to look ahead at where we're going to go to finish this up. Guys, I'm telling you, we come back together, we got about 3 weeks, and those last 3 weeks are going to go fast. So you all have been given the gift of time, and I encourage you to take advantage of that time. Not all classes get a free week off. So please, please, please recognize what you got. As you're studying, if you have questions, never hesitate to reach out to me. My phone still works in Savannah. So never hesitate to reach out to me. Let me know if I can help, if there's anything I can do. Otherwise, it's 1 o'clock. Y'all have a great weekend. Y'all have a great week. I look forward to your questions, and we'll see you guys in November.
Enjoy Georgia.
Thank you.
Bye.
Have a great weekend.
Bye-bye. All right, see you later, Julie.
Have a good week.
All right. Why can't you get off this thing?
Thank you. I didn't see that.